examination structure of the paper that you are going to write. So you first have to know how is the financial management paper examined. What is the subject weighting? Okay, so you see that we have environment for financial management. That is the first topic that we normally dealt with. That is the first topic. Me, if I'm coming to teach financial management, it is the environment for financial management that I always would teach first. So you look at the definition of financial management there. You look at the functions or the decisions that a financial manager has to make for the company to be able to achieve its objective. So this is the thing that I do. We have the functions of the financial manager, which are the dividend decisions, the investment decisions, the financing decisions, and sometimes the working capital management decisions. Then from that place, you look at the stakeholders that we have and their interests. From that place, then we look at the relationship between a person called an agent and also a person called a principal. You see that for large companies, the companies are not being run by the owners themselves. They appoint people to manage the company on their behalf. So if you are the owner of a company and you are not the manager or the director of the company, it means that your objectives, what you'll be wishing for the company, someone might not be doing the same thing because the person also have a personal interest. So we have issues with what we call the agency problem. Okay, the agency problem is for large companies, For a company like a small company that you are the owner and you are the person running the company again, you don't have anyone who will be doing what the person likes. No, you are the owner and you are the director, you are the manager. So there will not be any issue of agency relationship there. Okay, so from that place, we look at the agency problem. We look at the ways of solving it. We also look at some regulatory bodies like the Bank of Ghana, their functions. We look at the Securities and Exchange Commission, their functions, and we look at other issues. Okay, so that is the first one. It is always the question 1A, which will be examined for 10 marks, 10 solid marks. If you want to pass the financial management paper, you also have to understand the theoretical issues of the syllabus. It is going to be like 28 marks or 20 something marks or 30 something marks for theory and 60 something for calculations. So for you to pass the exam, you have to really be on top of the theoretical issues. It's very important. Okay. Then from that place, we come to the financial markets. The financial market is just a market where the borrowers and the lenders of fund, they need to transact business. So we can say that the bank is one of the participants in the financial market. If you look at the stock exchange market, we can also say that is a financial market because if you want shares, if you have a share and the company is listed, you can go to the stock exchange and become part of the owners of the company by buying the shares. So we look at the financial markets, we look at the types, we have the primary and secondary, we have the money and the capital markets. We also have over the counter and also have the organized market. We have a lot of the financial market. You look at them, you explain them, and the instrument that can be traded in each of the financial markets. Then from that place, we look at the issues of Islamic financing. You also look at the instruments that are traded in the financial market or the money market. We have the certificate of deposits, we have the treasury bill, we have the repo, repurchase agreements, and we have other items. So you be able to deal with them. For the new syllabus, 2019 syllabus, they are here to examine issues on the Islamic financing. So you have to be able to look at them very well and know the meaning, know the difference between them very well. All right. And we also look at the market hypothesis, where we look at the weak form, the semi-strong form, and also the strong form. So you'll be on top of those issues very well. Okay. Then from that place, you also see a question on cost of capital and sources of business. So the sources of business finance, and the cost of capital, they go hand in hand. Because if you want money, if you want to carry out an activity, you are going to get the money from somewhere. So the company can decide to use their own reserves, like they will decide to use their retained earnings, or if the retained earnings will not be able to undertake or to be able to complete the project, they can decide to use debt sources of finance where they will issue debentures. They realize that the debenture is not good, they can also use the equity, or they can also use what we call the finance list. So we have the short and then the long term. Okay. So they can ask you a question on the short and then the long term sources of business finance. They can also ask you the factors that you should consider before you select a source of business finance. Okay, what are the things that you have to look at? What is the duration for the money that you are giving? What is the cost associated with the money? What is the gearing level of the company? Currently, how is the company being structured? Are we having more of debt? If you're having more of debt, it means that you can no longer issue debt again. So you look at those issues. Then we look at the market listing. We look at the listing requirements for the instruments. We look at equity and debt. What are the requirements? You have to be on top of those issues. What are the methods of obtaining listing? We have the initial public offer. We have the placing. We have the introduction. We also have the right issue and all those issues. So you have to look at them, and you also have to look at how we calculate a theoretical strike price after a right issue, and also the value of a right. Okay, so from that place, then you now count say the money that you are taking. You have now decided to what? To use a particular source to get the money for whatever you want to do. Right now, you'll be paying interest. If you are issuing debt, you'll be paying interest on the debt. So what is the interest of what is the percentage of the interest that you are paying? That is what we call the cost of capital. So cost of capital is always calculated in a percentage. So what is the percentage of the amount of money that you are paying as interest? That is the cost of capital. If you are using equity, what is the dividend that you are paying? What is the dividend that you are paying? So we look at cost of equity, cost of debt, cost of convertible instruments, cost of preference shares, and we also look at if the company is using a mixture of sources. They are using part of debt, they are using part of equity. So we now look for the weighted average cost of capital. If a company is in the hospitality industry and the company wants to divert its operations, So the company wants to now enter into the music industry. You can see that the operations in the hospitality industry is different from the operations in the music industry. They are going to be having different kind of business risks. How do we appraise that particular project? We call something cost of specific specific projects. You can say cost of specific projects. We do that one by looking at a proxy company, a company that is already in the music industry. We use their financials to determine the operational risks or the asset beta. We call it asset beta, which is the business risks or the operational risks associated with the music industry. Then we now take the risks of the industry and we now factor in our capital structure to now get our equity beta. So we do that particular one, we call the gearing and regearing. The gearing and gearing, yes, those are the terms that you'll be seeing over there. That will go for 10 marks. You count to time value of money. The time value of money is the one that is just like what you have done at the SHS level. Some of you have done it at the degree level. The compound interest and simple interest. The simple interest is not always the focus of the examiner. So you'll be seeing compound interest, present value, future value, and all those things. If you are putting money in a bank and the interest rate is 5%, how much will you be getting at the end of 5 years? If you are going to be receiving 5 million from someone at the end or in 10 years' time, what is the value of that 5 million today? Present value and future value using compound interest. The compounding can be done maybe twice in a year, 3 times in a year. It can be quarterly, it can be semi-annually. From that place, then we come to annuity. Annuity is a situation where you'll be receiving a series of equal amounts at a particular period. So that is, you are receiving a constant amount, equal amount at the end of every month, or you'll be depositing an equal amount at the end of every year or at the end of every month. That's what we call annuity. Under the annuity, we have the ordinary annuity and also the annuity due. We also have something that we call perpetuity, where you'll be receiving that amount of money forever. That is perpetuity. Perpetuity has no future value. Yeah, man. Perpetuity has no future value. From that place, then you now use the application of annuity to do what we call loan amortization. Whenever you go to the bank and take a loan, how does the bank calculate your principal payment and those things? You can do it yourself. That is what we call the loan amortization. Sometimes you want to make a commitment. You want to buy or you want to build a house in 10 years' time. And the value of the house in 10 years' time is 10 million Ghana cedis. How do you save towards that? You can start putting a certain amount of money elsewhere towards that particular project. So we call it a sinking fund. So how do we go with a sinking fund? We also look at that. That is the time value of money. It is going for 10 marks. And for you to be able to answer question on time value of money, I bet you have to understand the principles very well, because time value of money questions are always tough. Okay, they are always tough. Then we come to what we call business valuations, mergers and acquisitions. So you want to value a business, assuming the company wants to sell. So before they want to sell, you can't be selling or you can't be using the book values to sell. No. What is the current market value of the assets? So you have to now bring the assets, the liabilities and everything to their current market value. So we have the valuation of equity, valuation of debt. How do we go about it? We will look at those issues. Okay. Then we also have mergers and acquisition. A company wants to expand. So if you want to expand, how do you do it? Do you want to go and acquire a different company, or you go and merge with that particular company, like Airtel Tigo? Okay, how do we go about it? We also look at that. Then we also look at financial risk management. Financial risk management, situation where a company in Ghana is selling to customers in US. You can see that the currency are different. If they are selling on credit, there will be issues with foreign exchange gain or foreign exchange losses. How do we manage it? We have so many methods of doing that. We have the internal and then the external. Okay, that will go for 15 marks. Business valuation is 20 marks. Okay, investment appraisal techniques, what people call the long-term decision making. It's just like the MA. It's just like MA, but this one is more advanced than the MA. We'll be having your basic methods, the payback period, the accounting rate of return, the advanced method, the NPV, internal rate of return, discounted payback. Then you now look at specific issues like taxation, inflation, capital allowance. You also look at lease or buy. You look at asset replacement decisions. You look at sensitivity analysis, and you also look at issues with simulations or probabilities. Okay, that will go for 15 marks. Then we now come to working capital management. How do you manage cash? How do you manage the inventory? How do you manage the receivables? How do you manage the payables of the company? That will also go for 15 marks. All right, so that is how the exam will be. Question 1A is environment for financial management. Part of it, the question B will be cost of capital or will be any issue relating to that. Okay, so what we do today is that we are going to be looking at the theory questions, and we solve some of the calculation questions too. Then we move on to the other issues. Okay, so we'll do cost of capital and right issue today, and part of the theory issues. Okay, someone should read the theory for us. Please, you people will be doing the theory. People will talk more on the theory because theory is not my thing. So you people will be talking more on the theory. After all, you are the one who is going to write the exam, not me. Okay, so someone should take the questions for us.
Question 1.
Okay.
As financial management is concerned with efficient and effective management of a firm's financial resources, the financial manager is mostly occupied with making important decisions to ensure shareholders' wealth maximization. Discuss the four major decisions that financial manager must make. Discuss the interrelationship between financing decisions, investment, and dividend decisions in a corporate entity. Differentiate between corporate ownership and corporate management. How does the separation of this present problems in corporate life?
Okay, so let's move on. Okay, let's take it. So you will be talking. Okay, so what's the discuss the four decisions that financial manager must make. What are the four decisions?
Investment decision.
Okay.
Financing decision.
Okay.
Dividend decision.
Okay.
Liquidity.
Okay, liquidity or the working capital management.
Working capital management.
Okay. All right, so they say you should discuss, no, you should state. What do you mean by investment decisions? What are the things that are considered to be decisions as regards to investments?
Hello, good evening.
Yes, ma'am.
The investment decision is a process whereby a proposed project is worth to be undertaken, and the needed resources is being allocated to it among these various projects.
Okay, that is okay. That is fine. That is fine. Someone else?
Financing decision.
No, are we done with the investment decision?
Okay, investment also has to deal with the acquisition of assets that will be used to generate inflows for the entity.
Okay, 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 okay. That is fine. Anyone else on the investment decision before we move on to the other one?
Hello.
Yes, please.
Good evening.
Yeah, good
Okay,
evening.
so I can say it covers the allocation of capital or commitment of funding to long-term assets.
Okay, 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 okay. That is fine. So if you talk about business, if you talk about investment decision, the investment decision, our concern is the company it has to do with expansion. Okay, so we want to expand we want to expand our operations. How do we expand our operations? Do we have to buy additional non-current assets? So the investment decision is more like acquisition of long-term assets, non-current assets. So we want to expand. How do we expand? Do we want to increase our production level? If we want to do that, what do we have to do? We have to acquire assets. But before we can acquire that particular asset, we have to know if that particular asset is going to generate a return to us. And that is why we use the investment appraisal techniques. Okay. We want to expand our operations. Do we have to go and acquire additional subsidiary, or do we have to go and acquire a subsidiary? Do we have to invest our surplus funds into the shareholding of another company? Do you have to go and buy treasury bill? We are talking about how do we use our surplus funds, or how do we expand our operations, or how do we maximize the shareholders' wealth? What are the projects that we have to invest in? Mostly is this investment decision is associated with a decision or investment that is going to be involving a lot of money. It's going to involve a lot of money. That is the investment decision. The investment always has to do with the acquisition of assets, not just an asset, the long-term assets. Do you have to go and buy shares of another company? Do you have to go and buy a subsidiary to expand our operations? Those things that are concerned with the investing activities that you have in the cash flow, those are the investment decisions. Okay, let's go to the next one. Financing decisions.
So financing decision also has to do with raising of finance from various financing sources like debt or equity. And then at the same time, the decision has to also go with how to reduce the cost of capital, because the various options will have the various costs associated with it. So as finance manager, you will have to, explore all available options to get the least costs of raising finance to be able to maximize profits.
Okay. No, yeah, for financial management, our focus is not on the profits. Okay, our focus is always on the maximization of shareholders' wealth. Okay, profit is not cash. Okay, you can make a lot of profit, but you will not pay any dividend to the shareholders. So their wealth is not what maximized. So that is basically about a financing decision. So financing decision has to come in after investment decision is being made. So you have identified a project and you don't have money. You have identified a project. We want to buy a car, a delivery car. Okay, we can't just go to the car dealers and dance for them and get the car. No, we have to go and send money there. So what is how do we get this particular amount of money? How do we get it? Deciding on where to get it has to do with the financing decision. Okay, so do we have to issue debts or equity shares, or do we have to use our reserve? Or do we have to go for a bank loan? What do we have to do? Or where can we get the money? Where can we get the money to be able to buy this car? You can't say that you are going to be taking a bank loan because your brother is a bank manager there. No, you are working for the organization and you have to do things that is going to maximize the shareholders' wealth. So you look at the options. There's so many options, either debt or equity, and look at the cost associated with each of these options. Then you decide on which of the options that you are going to be using. That is the financing decision. So the finance manager has to identify the various sources of business finance and choose the one with the least cost. That is the financing decision. Let's go to the next one. What is the next one?
Hello.
Yes, please.
It's a dividend decision.
Okay.
It also has to it deals with the financial manager taking decision as to how to plow back profits to gain more
Jonah, you just assume that you are in the exam hall. Just say whatever you'll be writing there, because you are not going to leave that space blank. Okay. So
it's
yeah.
financial manager taking decision, the amount of to each shareholders, and then the amount of back into the organization.
Okay. All right. That is nice. That is not bad. Thank you very much. Yeah, Sneha Sharif, you wanted to talk. Bafo, you wanted to say something?
Yeah.
Yeah.
I would also want to add is that the financial manager gives advice on the appropriate dividend policy that the company should adapt
Okay.
in giving dividend to shareholders.
Okay. Okay. I hope we are aware of dividend policies that we have. Okay. So this one, the finance manager making a decision as to the dividend payout ratio. What portion of the profit made for the year should be paid as dividends and what portion should be retained? So the finance manager will now looking at the volume of the company's activities and the volume of cash that they need. They will now advise the company on the kind of dividend policy that they should be using, whether they should use a payout ratio of 30% or they should use a payout ratio of 20%. All right. Okay. The next one is what? Okay. The last one is what?
A working capital decision.
Okay. So the working capital decision, what is the, what does it involve? It involves what and what?
It involves the non-current assets.
Are you sure? Working capital.
Current assets and current liabilities.
Okay. Okay. So it has to do with the kind of investment that we should put in our current assets and our current liabilities to just maintain a good position of the company. So it has to do with managing your liquidity issues. So what is the amount of investment that should be made in receivables? What is the amount of investment that should be made in cash? How do you use your surplus cash? How do you make sure that cash is available to settle your short-term obligations when they fall due? So it has to do with the management of what? The working capital items, the current liabilities, and also the current assets. If you want to purchase inventory, what do you have to use? Do you have to go for bank overdraft, or you can use trade payables? You have to know that trade payables has no cost of capital unless you have defaulted the terms. In that case, they will charge you interest on overdue amount. But if you are able to pay within the stipulated period, you're not going to be paying any interest on trade payables. So you can say, okay, I'm going to be using trade payables to finance my current assets, maybe the inventory or the receivables. So you have to make a decision as to this particular issue so that you will not be in a liquidity problem. That has to do with the working capital management decisions. They have asked this question before, not that they asked you to discuss. They were listed and students were asked to explain. 4 of them for 10 marks. Each of them was 2.5 marks or 2.5 marks. That was March 2023. Okay, so this has been asked before and they can still ask. Let's go to the next one. Discuss the interrelationship between financing decisions, investment decisions, and dividend decisions in a corporate entity. What is the interrelationship between them? Do they have any relationship? Do they have anything in common? Is there any interrelationship between investment, financing, and dividends? If they say interrelationship, do we understand interrelationship between something? What is the interrelationship between human being and plants? Seniors, if they say interrelationship, do we understand?
Yes, please.
Yes.
Okay, so let's now answer the question. Discuss the interrelationship between financing decisions, investment, and dividend decisions in a corporate entity. Is there any interrelationship between them?
Now, let's move on to foreign exchange law. Will a foreign exchange law?
Yeah, so when you look at these decisions, like they are interrelated in the sense that, let's assume that you have a project with positive NPV you want to undertake.
Okay.
That decision is an investment decision because
Okay.
you've considered all the factors, the benefits, and then what have you, and then you've decided that this is the investment that we want to make. And because of that decision, it also falls on the fact that, before I can undertake this project, I need finance.
Okay.
I need money to be able to do it.
Okay.
So because taking investment decision, then you also have to take financing decision to help you to be able to achieve the investment decision that you took earlier on.
Okay.
And since financial management is about maximizing shareholders' worth, you are within a corporate entity. And for that matter, you need to make sure that you maximize or ensure the maximization of your shareholders' worth. And when you finance your decision with
4 million
the
all over the loan amount of 20, right?
Oh, senior, I'm enjoying your this, your submission, but I don't know why the network is not allowing you.
Then you multiply it by the foreign exchange loss amount. The foreign exchange loss amount is
Senior, we can't hear you again. Oh, he was making a nice, yes. I was enjoying the thing. He's gone. Someone should complete this thing for him before he comes back.
right. Then you have to allow.
Auntie Agnes,
How do you get it?
finish hard for him. He'll come back.
Total of foreign exchange
Auntie Agnes,
140,000
I know you can hear me.
minus the allowable.
She will say
And
she's
let me, I don't know if what he was saying was that it's what he was saying at the end, no,
yeah.
was saying the financial manager is their duty to maximize shareholders' wealth. And since as a FM, man, you need to maximize your shareholders. So since you're paying out dividend to your shareholders, it also depends. Dividend decision depends on the financing decision. If I don't leave now, what he was trying to say.
The last part is okay. Yeah. So the dividend decision depends on where you are getting the money from. If you are using debt, it means that you'll be paying interest out of the profits. So the amount of dividend that you'll be paying to your shareholders might not be if you are using equity. Okay. So he was making it, in fact, he was making a nice submission. Someone should add some, then I'll also take it, then we move on to the next one. So someone also should come with the interrelationship before I also give my last one. Then we move on to the C. Adam, do you have something for us?
Oh, yeah, I said it all, so it's okay. Said it all.
Yeah, I said it all. I like what he said. I didn't get them. So if you can, polish what the things that, if you can summarize the things that he has said.
Okay, so we know that financing decision is dependent.
Is that how
on
you are
the-
going to start the if you want to answer,
Oh,
how you are going to
I mean,
start?
I should polish it. So I'm just polishing it.
Okay.
So the ability to raise finance, because maybe you have identified an investment opportunity, you want to raise some finance and then invest. After investing, you definitely make some returns. So the returns that you make, how you pay your shareholders or those who help you raise the funds, and then how much you retain the company to keep it running. Yeah, so that's what I was saying.
That's the polishing that you say you are doing.
Yeah, that's the polishing I'm doing.
And I should get to know where you are buying your polish. Because
Why is it fake?
it's very fake. Okay. So let's come to the question over here. The interrelationship between financing decision, investment, and dividend decisions. Okay. You see, before a company will say they are going to get a finance, or before the company will say, okay, we need money. They can't just stand up and say they need money. They will not need the money, like they will not go and get the money and use it to buy food to eat. No. A company will go for a finance, or the company will decide to get a finance from, maybe they decide to get loan from the bank or anywhere. They will decide to get money from somewhere for a reason, and that reason might be a project that they want to undertake. You can't just stand up and say you are going to the bank for a loan. No, you are going there for You are going there to take the loan for a reason. That particular reason is a decision that you have made regarding what maybe a particular business that you want to undertake. That particular business that you want to undertake is an investment opportunity. So you can't raise a finance if you don't have an investment opportunity or no decision has been made on a project that you want to undertake. So investment decision will always lead towards the financing decision, because you can't go to the bank and say you are going to get money to come and buy food and eat. No, you go there for a reason. And the reason that you are going there is a decision that you have made regarding what? Investment. So investment decision will always bring the financing decision. So where do we get the money from? Now we want to buy a car. How do we finance the acquisition of the car? Do you have to use our retained earnings? Or do you have to go to bank for a loan? Do you have to issue preference shares, or do we have to issue debentures? Do you have to issue bonds, or we have to issue equity shares? So it's the investment decision that will inform you, or that will lead towards the financing decisions. So that is the relationship between the investment and the financing. Okay.
Now,
then you now come to a dividend decision. Dividend, you want to know the amount of the return that you'll be paying to the shareholders and the portion that you'll be retaining. You see, if a company is being financed through equity, there's no debt. It means that the company will not be paying interest out of their profits. The only thing that they will be paying is tax. So basically, much of the profit will be available where the company can pay enough dividend to the people. But if the company is having a lot of debt, or the company is financing the operations through debt source, it means that the company will now be paying interest on that particular debt that they are getting. And that particular interest will be taken from the profits before dividends will be declared. So if you are using debt and the portion of the debt, the volume of the debt is very high, and the interest that you are going to be paying will be very high, it is going to be affecting your dividend policy. Sometimes if you go and take money, the debt holders will include a clause in the agreement, that something that we call a debt covenant, that you cannot declare dividends if this amount of profit is not made. So if you are using debt as a source of finance, you will be limiting the amount of dividend that you'll be paying. So that is the interrelationship between them. So if you are using equity, it means that equity, no interest will be paid, you just pay dividends. So maybe you might have a lot of profits and you can pay enough dividends, or you can declare enough dividends. But if you're using debt, the interest that you are paying will be taken from the profit before you declare dividends. So it depends on the source of finance. It depends on the source of finance. Let's look at the C. Differentiate between corporate ownership and corporate management. How does the separation of these present problems in corporate life? Let's now take the first one. What is the difference between corporate ownership and corporate management? And what are they trying to, what can you capture in this particular question? What are they trying to talk about? What theory are they trying to talk about? What principle are they trying to talk about?
They are trying to talk about agency and principal, agent and his principal.
That is very nice. So they are trying to they are trying to examine you on the issues of our agency theory. Okay, that's what they are trying to examine you on. Okay, so let's now differentiate between what we call corporate ownership and corporate management.
Hello.
Yes, ma'am.
Corporate ownership talks about owners having a hold of legal rights and responsibility for a company that they have.
Okay.
And the corporate management talks about responsibilities assigned to leaders that have been those given position in the company, like the management, to see to the day-to-day activities of the organization.
Okay. Okay. How does the separation of these present problems in corporate life?
Yeah, so when the owners are those who have contributed their resources together to undertake to undertake the operations of the entity. But because they wouldn't have the time, they have entrusted those resources in the hands of other people called management.
Okay.
So when you look at the scenario, we have two separate groups of people.
Okay.
Now the owners and then the managers.
Okay.
And sometimes the focus of the owners may be different from that of the management.
Okay.
And for that matter, it brings about agency problem, because sometimes the agents like the owners think that their resources are not being used in the way that they want it to be used. And management also think that we are the managers, so we have to do what is right in our own eyes. So those things bring about a lot of problems.
That is very nice. But I just like, the only thing I don't like is that you are not putting yourself in the shoe of the managers. That you as a manager, you'll be looking for fat salaries and also fat bonuses. You want to use the company's money to buy a car. You want to show off. That is the interest of the managers. They want fat salaries, fat bonuses. They want Porsche cars. The company should give them cars. They want traveling allowances, and those things at the expense of the owners. The owners, they're just saying that the company should make enough return on their investment. The company should pay enough return on their investment. But the managers are also thinking that we should increase our salary, buy cars for us, do lunch for us, and some things. And these things will be done out of the company's resources. So if you are using the money to do all these things, what will be the money that will be left that you pay to the shareholders as a return or as a dividend? So the shareholders, their motive is that the managers have to manage their resources in their best interest, which will maximize their shareholding. But if management is doing this, it means that management will be suffering, because they will be taking low salaries, because if they are taking lower salaries, the profit will be higher. Assuming that profit is cash is cash profits. If you are taking low salary, the cash profit will be higher, and much of return or dividend to be paid out of the profits. But if management are buying cars for themselves, they are increasing their salary and those things, they are going to be doing this from the company resources. What will be left that they will pay to the shareholders as a dividend? So you can see that the two of them are having different interests, and this conflicting of interest bring the issue of the agency problem. Okay, so management will be having a different motive apart from what the shareholders are expecting them to do. Shareholders will be asking management not to undertake this decision or not to undertake this project. But management, since the money is not for them, they would like to undertake that particular project, because they are seeing it to be something that is big, because the money is not for them. So they are seeing it to be something big. But shareholders are seeing it that if things should go wrong, their investment will be lost. The management will not look at it. Management would like to undertake that particular decision. That's why we have the problem over there. So the problem has to do with the difference of their interest, differences in their interest. Okay. Differences in their interest. Okay. Let's come to this one. Someone should take the question 2 for us. Then let me see whether we have some. Okay. So let's look at the question 2. Question 2, you can see that there is agency problem there, isn't it? Okay,
Yes.
how you can use share options. Share options, one of the tools that we use to reduce the agency problem. You can tell the managers that if you're able to do well, by the end of this time, we are going to make you part of the owners of the company. We give you share options. So just to motivate them to do the right thing. Another one is also threat of dismissal. You tell them that the next time you do this, we are going to sack you. You'll be fired. So we have so many ways of doing that, and that is not a problem. But let's look at the 3B. The 3B. 3B. The 3B over there, they are saying that distinguish between a defensive security and aggressive security. Bring out clearly the importance of their futures. Okay, so what is the difference between defensive security and aggressive security? What security that they are talking about over here is not security in the, like this, your police and soldiers. That's not the security that we are talking about. We are talking about securities in the stock exchange markets. So shares and those things that are the things that we are talking about as the securities. Okay, so don't go there and be talking about police and those people. No, it's not that kind of security that they are talking about. They are talking about security that are traded on the stock exchange markets. So we have something that we call defensive security and aggressive security. What is a defensive security and what is aggressive security? The difference can be the definition. That is one way of differentiating between two items. You can just define them and move on. All right. What do you mean by a defensive security? Or today is our first time hearing it?
Yeah, for me, I've not heard it before.
Okay, but you have heard about.
Yes, please. My first time hearing this.
Okay, but you have heard about beta factors before. Equity beta and those things.
Oh, yes, that one.
Okay, okay. So the is the beta factors that we use to define a security being defensive and a security being aggressive. Any security that is having a beta factor, that is having a risk factor more than one, is called aggressive security. But any security that is having a beta factor less than one is what we call the defensive security. So it will be maybe from 0 point something to 0 to 0 point something. That is what we call the defensive security. Any security that is having its beta factor, its risk factor, the risk associated with the security is higher than 1 point, is higher than 1.0, or the beta factor is 1.0. We call that particular security aggressive security. And aggressive securities are going to be having a higher return. They come with a higher return. Aggressive securities.
This is what I want to say something.
Aggressive securities always come with a higher return because of the risks associated with it. They have a higher risk. They have a higher risk associated with them. If care is not taken, your investment can just go like that. That's good. So they come with a higher return. Aggressive securities come with a higher return, and their beta factor is always more than 1. It's higher than 1. Okay, that is what we call the aggressive security. But defensive security is a security that is with a low level of risk, and their beta factor is less than 1. It's less than 1, but more than 0. Okay, and this will always come with what? So sometimes we use the government securities as the defensive securities, the risk-free ones. The risk-free securities like the treasury bill and those things can be seen as what? As a defensive security. But investment in private securities, you see that private securities are something that is for private. Those people, they can go out of business anytime. So they are classified as aggressive security. The takeaway is that any security having a beta factor less than 1 is called a defensive security. But any security that is having more than a beta factor of 1 is aggressive security. Are we okay now? All right.
Yes, sir.
Okay. Let's go to question 4.
Linus, Abel, can you explain the aggressive again?
Aggressive is a security that is having a higher level of risk, and their beta factor is more than 1. All right. In corporate finance, capital structure refers to the mix of various forms of external funds known as capital used to finance a business. It consists of shareholders' equity, debt, and preferred stock, and is detailed in the company's balance sheet. Required, identify 4 determinants of capital structure. for you to be able to answer this question, you first have to know what we call a capital structure. A capital structure is the long-term capital of the company. The long-term capital of the company is the capital structure. So how is the company being structured in terms of the long-term capital? What portion of, so the capital structure is just the capital employed, is the component of the capital employed. So you have the equity, the shareholders fund, and also the debt. Current liabilities and all those things are not part of it. So the capital structure is just the long-term sources of, or the long-term capital structure of the company. Okay. What are the things that is going to determine how the company should be structured? What are the things that is going to inform the company having a capital structure of maybe 60% of equity, 40% of debt? Or what would the company see before they will say, okay, looking at our structure, we want to go for additional loan. So what are the determinants? What are the things that the company will see before they will say, this is the capital structure that we want to have? That's what they are asking. That's what we are asking. Okay. One of those factors is what?
The nature of the investment.
The nature is if you are talking about a determinant of capital structure, we are not talking about we want to undertake an investment. No. We are just looking at how should the company be structured. What should be our optimal capital structure? Is it going to be 60 equity, 40 that one? So it don't really have to do with investments, but it depends on how you are able to support what you are saying, because nothing is wrong. You're able to convince the person, that is fine. All right. Let's look at the.
Well, sir, can you say the size of the company?
It's not that can we say the size of the company is one of the factors. It's not that we say the size of the company. If the company is very big, it means that the capital structure is also going to be somehow manageable. Yeah. The first one is the size of the company. The size of the company. The next one will be the industry in which the company operates. You see, some of the industries, they have an industry average for some of the ratios. So the debt to equity ratio, it can be, or the capital gearing. The company, the industry can have a capital gearing ratio, which will be something that all companies might be aiming towards. So they can have an industry average for the capital structure. So the type of the industry that the company operates in is also one of the factors. So the industry in which the company operates in is also one of the factors. Another one is also the dividend policy that the company is using. The dividend policy that the company is also using. The dividend policy can also do that. The current gearing level of the company. What is our current gearing level? What is the composition of our capital? What portion is debt? What portion is equity? You can also talk about the liquidity issues with the question. The liquidity ratio, the current liquidity level of the company. The current liquidity level of the company. If you are not having cash and we want to now make debt should be up to equity, it means that we will pay interest on the debt. Where do we get the money to pay the interest? So the liquidity level of the company can also determine the capital structure. This one, you can just take your phone and Google it. It's not a big deal. All right, let's come to question 5. Okay, someone should take the 5 for us.
A short-term finance is usually needed for businesses to run their day-to-day operations, including payment of wages to employees, inventory ordering, and supplies. A range of short-term sources of finance are available to businesses. Require differentiate between factoring and invoice discounting. B, explain why an entity might choose either bank overdraft or short-term loan to finance its day-to-day operations. And C, differentiate between scrip dividend and scrip issue.
All right, thank you. let's differentiate between factoring and invoice discounting. What is factoring?
Factoring is where you sell your debt to a factor to be able to raise finance to undertake whatever activity that you want. So under factoring, I think we have two modes of factoring, but one what's in there?
Or if
And
you are not
with
if you
recourse
can't-
and without recourse. So
if you
what
can't
in there?
remember, just
Yes,
say what.
yes.
Don't touch on them. If you can't remember, don't go and lie. Just say whatever you are sure of and move on.
Yes, there one with recourse and the other without the recourse. Yes.
Okay.
Yeah. And with invoice discounting, you sell the debt at a discount to
It can be the
to
factory company. It can be anyone at all.
to raise the money, because you might need it. By the time that you wait till the debtor pays the money, will take a long time. So you discount it and get money right now, so that when the debtor pays the money, then you also the person takes his money with the interest that comes with it.
Okay. Okay. That is not bad. That is okay. That is okay. Anyone factoring and invoice discounting?
Why not?
Yes, please.
Hello?
Yes, Senior, I can hear you.
The invoice discounting is the purchase of trade debt at a discount by the companies who are into those kind of operations.
Okay.
They buy this thing from the firm at a price lower than the what the business would have received from the
So you are only going to talk about the invoice discounting and they say depreciate too. So you are going to talk about invoice discounting and leave the factoring.
it's because someone has already talked on this thing.
Okay. Okay.
Yeah, that's why.
Okay. I thought you are leaving a space for the factoring so that you go and come
No,
back.
no, please.
Okay. Okay. All right. So all the things that you have said, they are all correct. They are not bad. They are no. Okay. Factoring has to do with a sale of mostly receivables, and invoice discounting has to do with pledge. You are pledging. Okay. So factoring has to do with you now outsourcing the administration of your receivables. Okay. So you have receivables that you need money. What you do now is that you can go to a debt collection company and say that, okay, this is the amount of receivable that I have. I want to sell it to you so that you can chase those people to collect the money. If you're able to collect the money or not, we are not coming for any refund. So we are going to give the receivables to you for money, or we are going to sell it to you. And after selling it, whatever happened with it, you will not come after us. So that is the factoring without recourse. The recourse is where the company will just go for one-time payment from the factor or the factory company. And whenever the company, or if the company is able, the factory company is able to collect all the money or not, they will not do any other payment to the company. That is what we call the factoring without a recourse. But we also have another one, which is factoring with a recourse. This particular one, the company is not selling the receivables to the factoring company or the debt collection company, but the company is just telling them that, okay, help us collect the money. But before you do that, give us some advance of the money that you'll be receiving. So with the recourse, the debt, if the period for the collection has elapsed and the debt collector or the debt collection company is not able to collect the listing, they will now bring the receivables back to the company and come for their money at an interest. Okay, so that the factoring with a recourse is similar to the invoice discounting, but the difference is that the invoice discounting, the administration of the debt is done by the company. But for the factoring, the administration of the receivables will be passed to the factory company. So whatever expenses over there, it will be those people that will be chasing the people for the money. Okay, but if you come to invoice discounting, the invoice discounting is just like you are using the debt as a collateral security to take loan. So we have this amount of money, and this is what we need. You'll be giving the loan to us at an interest. Okay, we are going to be receiving 200,000 in 2 years' time, and we need the money today. So if you are giving, we are bringing only 200,000 to you. So what amount should you give to us? So that if you calculate the interest of 10% on it for 2 years, you will be able to be getting the 200,000 so that we can pay you. So they will now give you the amount at the present value of the amount that the people are owing you with the borrowing rate that the company or the bank will be using. So the invoice discounting is more like using the receivables to take loan. And the administration of the receivables is still in the hands of the company. But for the factoring, you might either be selling or you might also be using the receivables to take amount of money from those people. Because if the receivables are not collected within the stipulated time, the people will now refund the money to you and come for their money. But for factoring, the administration is in the hands of the factoring company, not the company itself. Okay, that is the difference between them. Explain why an entity might choose either bank overdraft or short-term loan to finance its day-to-day operations. What do you think they are asking you over here? What do you think is the requirement of this particular question?
Short-term finance of a business.
Okay, and yes, it's about short-term finance of a business, but what is the requirement of this question, this particular question? Explain why an entity might choose either bank or
the advantages of short-term finance.
No, it's not the advantages of the short-term finance itself. No, it's the advantages of either bank overdraft or short-term loan. If you are using bank overdraft, what are the advantages that the company will be having? If they are using a short-term loan, what are the advantages that the company will be getting? That's what they're asking over here. So you will choose bank overdraft for a reason, and you will choose a short-term loan also for a reason. So they are asking for the advantages that the company will be getting if they choose bank overdraft to finance what? A short-term operation. They are also talking about advantages that the company will be getting if they choose a short-term loan to finance their day-to-day operations. So for you to answer this question, you talk about maybe the meaning of bank overdraft and the benefit that the company will be getting if they decide to choose what? Bank overdraft. The short-term loan, the benefit that the company will be getting if they decide to what? Choose what? A short-term loan. That is what they are asking. So let's take it. If you are choosing a bank overdraft, okay, first of all, you can define what a bank overdraft is, assuming that the examiner does not know what we call bank overdraft. So you have to educate him some more on a bank overdraft, and we'll talk about the benefit and the reason that a company will choose the bank overdraft to finance their day-to-day operations. What is a bank overdraft?
Hello, sir.
Yes, please.
It is a credit facility granted to only current account holders to overdraw their account.
Okay. So if you are using bank overdraft to finance your operations, what are the advantages that you'll be getting?
It is flexible.
Okay, it is flexible. Okay, sometimes they have a limit. It depends on your operations. They can give you a limit which you can be able to withdraw more than a short-term loan. Okay, So it is flexible. They have a limit. They have sometimes the company they set bank overdraft limit for the people depending on your operations. Okay, depending on your operations. Okay, and you can see that it is accessible at any time. Bank overdraft, I don't think you have to go and fill a form like the process that you go through before getting a loan. I don't think those stress you'll be going to those particular stress. Okay, so you talk about the advantages that if you are using a bank overdraft, but if you come to the short-term loan, you see the short-term loan, if you're using a short-term loan, you will see that the payment will always be planned. The bank overdraft, there is no payment plan for it. As soon as the money hits your account, the bank will do a deduction. It's an automatic deduction, just like quick loan. You see the quick loan, whenever the money hits your account, they will just take it. They don't have any payment plan for it. But for a short-term loan, the bank will give you a payment plan that at the end of every year or at the end of every month, you have to pay this amount. Okay, there's a payment plan for it. Okay. For the short-term loan too, for the bank overdraft, the interest is always charged on the remaining amount. Okay, the interest payable is always on the remaining amount because if the money hits your account, the remaining balance over there is the amount that the bank is going to be charging interest on. Okay, for the short-term loan, the company can be able to plan. The company can be able to plan because of the payment plan. So you know how to plan your finances. Okay, if you have 10,000, you know that out of this 10,000, I'll be paying 5,000 as interest. So how should I use the remaining what? 5,000. So the company can plan their finances if they are using short-term loan. Okay, and those are some of the advantages that the company will be getting. So you just talk about the advantages and also the advantages of those one and why the company, that is the why. The company will choose the bank overdraft for a reason. The company may choose the short-term loan also for a reason. Let's now come to differentiate between scrip dividends and scrip issue. What do you mean by scrip dividends and what do you mean by scrip issue? Should I be mentioning names? Auntie
Hello,
Bafo.
sir.
Yes, yeah.
Please, sorry to draw you back small.
Okay.
With the bank overdraft and the short-term loan financing, can you use interest as also a basis for distinguishing between the two?
Yes, please.
Putting one.
Yeah, you can use interest, yeah.
Okay, right. Thank you.
All right. Auntie Bafo, scrip dividends and the scrip issue. Why is the difference? Hey, please, are we saying that we haven't heard about the scrip dividend and scrip issue before? Have you heard about bonus issue before?
Yes, sir.
Okay. What is a bonus issue?
How do we then get our capital?
Auntie Sarah, what is a bonus issue?
Okay.
Adam, what is a bonus issue?
It's when new shares are awarded to like existing shareholders. That is a bonus issue or the scrip issue. So when you are issuing new shares, then you give some to your existing shareholders.
Are you sure?
Yes.
That is a bonus issue.
Yes.
So if you are issuing new shares at a market value of 2 cedis and all the existing shares are buying it, that is a bonus issue.
Come again.
You have forgotten. You heard what I said. Okay.
Linus,
Oh,
Yes, yeah.
can we see, I think it's where new shares are issued to existing shareholders at a price lower than the current market price.
Hey, as many bonus issue. Hey, you have Philip,
Yeah.
you have that FR and you are even doing FM again. Hey, as many.
So it is given to existing shareholders to subscribe for additional shares.
At a price.
Yes.
No, that is not a bonus issue. Auntie Agnes. Okay, Auntie Agnes, you say that she's in a car. Auntie Bafo, what is a bonus issue?
Hello.
Yes, ma'am.
Yes, please, I just go home.
Okay, okay,
But I heard you mention my name.
okay. Bonus issue. What is a bonus issue?
Oh, okay. So it's where shareholders are given shares according to their existing shareholding, without any price. As in, they don't pay anything for it, but then it is paid for from the reserves of the company, something like that.
So you are going to be adding something like that in the exam.
No, please.
Okay. Okay, so that is it. A bonus issue is you issuing new shares utilizing your reserves. So changing your reserves to equity shares. That is what we call a bonus issue. Bonus issue does not come with any cash. We are changing the reserves to what? To equity shares. So we are going to be given a ratio that we are going to make an issue of 1/2. So this 1/2 will now be financed through our reserves, mostly the retained earnings. That is what we call a bonus issue. Bonus issue does not come with any amount, but you are just changing your reserves. The reserves, sometimes the reserve that a company is having is plenty, and they want to what? They don't want to cause a dilution in the ownership. They don't want to have a new owners joining the company. So they can decide to what? Issue their new shares through a bonus issue, utilizing their what? Their existing shares. Sometimes we're also looking at the cost. If you are issuing new shares to outsiders, you are going to be incurring issuing cost. But we don't want to incur that particular cost. So we have to change our reserves to what? To the shares. So we are utilizing our reserves. That is what we call a bonus issue. Let's come to what we call a scrip dividend. Scrip issue is the same as a bonus issue. I just want to draw your attention to it. So you see scrip issue. If you see a scrip issue, it's the same as a bonus issue. Take note of that. Take note of that. Scrip issue is the same as bonus issue. Let's come to scrip dividends. Mostly dividends are paid in cash, isn't it? Mostly dividends are paid in cash, isn't it?
Yes.
Okay, a company can decide to issue shares in payment of the dividends. That's what we call the scrip dividends. So instead of the company paying cash to the people, they are now issuing shares to the value of the dividend that is supposed to pay in cash. That's what we call the scrip dividends. So using shares to pay for the dividends, using shares to pay for the dividend is what we call the scrip dividends. Instead of paying cash, they are issuing shares to the value of the dividends. That is what we call the scrip dividends. We also have a right issue. The right issue is just issuing shares to the existing shares in their proportion of ownership at a value lower than the market value of the shares. So right issue will always be done at a discounted price. Right issue has a component of a full market issue and also a bonus issue. So what people are saying, someone said that the shares will be issued at a value lower than the market value. That is a right issue. So the right issue, you issue the shares to the existing shares. It's a right given to them. Someone can decide to utilize it. Someone can decide not to take up the right. There's no problem. But if you don't take up the right, it's going to affect your shareholding. Okay, so issuing shares to the existing shareholders in the proportion of their ownership at a value lower than the current market value is what we call the right issue. Okay, and the shareholders, the existing shareholders have a right that we call the preemptive right. The preemptive right is a right that is given to the existing shareholders to what? To subscribe to the shares before the remaining shares will be given out to the outsiders to subscribe to. So the right that is being enjoyed by the existing shareholders to first be the people to subscribe to the shares before the remaining shares will be issued out to the public is what we call the preemptive rights. So you have to take note of those issues. We now enter the calculation section, and the first one will be a right issue. If there is a right issue, a lot of things will happen. Okay, the shares will be issued at a value lower than the current market value, which we call the cum-ex price. Okay, the shares will be issued at a value lower than the current market value. That particular discount over there will be affecting the total value of the shares. So the shares before the right issue, or the value of the shares before the right issue, and the value of the shares after the right issue, they will never be the same. So there will be a changes over there. What do we call that changes? If a person, after the person subscribe to the right, or after the person exercise the right, the person can decide to sell the right. What would be the benefit that the person will be getting from it? What we call a value of a right. Okay, so when there is a bonus issue, there are so many issues that will be coming. The shares after the bonus issue, the shares after the right issue will not be the same. And anyone who wants to sell the right after subscribing to the right will be getting a gain or loss. So we look for the theoretical extra price, which is the price of the share after the right issue, and also a value of a right. The person wants to sell the right. How much gain will the person be getting from the right? That is what we call the value of a right. So we pick the first two questions under the right issue. And okay. All right. So let's take the first one. Let's take the first one. I'm sure that if we're able to solve the first one, the second one is automatically solved. Okay. So which of them should we solve? Should we solve the second or the first?
Second.
Okay, let's solve, because the second is plenty, isn't it? Okay.
Yes.
Let's solve the second one. Okay, someone should read the question for us. Who is reading for us?
Compaq has issued 3 million ordinary shares of $1 each, which is at present selling for $4 per share. The company plans to issue rights to purchase one new equity share at a price of $3.2 per share for every 3 shares held. A shareholder who owns 900 shares thinks that they will suffer a loss in their personal wealth because the new shares are being offered at a price lower than the market value. On the assumption that the actual market value of shares will be equal to the theoretical X right price, what would the effect on the shareholders be if A, they sell all the rights, B, they exercise half the right and sell the other half, C, they do nothing at all?
Okay, so what we'll do is that we are going to be adding the first point for that one, where they say they take up all the rights. So it takes up all his rights, then they sell all the rights, they exercise half the right and sell the other half. They do nothing at all. Okay, so those are the things that we'll be looking at over here. So first of all, you can know the effect that will be the shareholders who owns the 900 shares will be having if the person is selling all the rights and these ones. You can't know that. So the first thing is that you always have to find the theoretical XY price. So you always have to find the theoretical XY price before you can know the effect that the right issue is going to be having on the shareholding of a particular shareholder or existing shareholder. So the question will not ask you directly to calculate theoretical XY price. We cannot know the effect that the shares will be having on the right issue will be having on the shares of the existing shareholder if we don't know the value of a share after the right issue, because they are going to be asking you to do this after the right issue. The question is, the person sells the right. So what is the value of the shares after the right issue, which is the theoretical XY price? What I'll be doing is that I'll be using the two approaches for the theoretical XY price calculation. I'll use the total approach and also total approach and then the unit approach. Okay. Okay, let's come to what is the value of the existing shares that we have before the right issue? How many shares are there? Before the right issue, the company has how many shares?
3 million.
Okay, selling at what? Their market value is what?
4
1
cedis.
cedi.
The 1 cedi is a par value. That is the value attached to the time, to the shares at the time of registration. We don't use
$4.
we use the present market value. So the
$4 per share.
okay, that will be $4. The total value will be 12 million, isn't it? Okay. This is the amount that we are having currently for our shares. Before the right issue, the company is having a total value of 12 million, which is the market capitalization rate. Is 12 million, 300 million shares times the 4 cedi. That is the share price. Okay. Let's now count the total value that we'll be having from the right after the right issue. Okay. What will be the cash that the company will be realizing from the right issue? Let's look at the right issue proportion. How is the right issue done? In what proportion? The question will always give you 1-for-2 or 1-for-3 or 2-for-5. How is the proportion done? The company plans to issue right to purchase 1 new equity shares at a price of $3.20 per share for every 3 shares held. So how are they doing it? What is the proportion? What is the
It's 3:1.
No, please. It's 1
It's
1/3.
1:3, sorry.
Okay, so 1-for-3. You bring 3 of your existing shares for 1 new. Okay, what is the total value of the existing shares that we have?
3 million.
They are saying that bring every 3 of these for 1. So how many shares are we bringing for the 1 in total?
That's 1 million.
Okay, that will always be calculated as 1/3 times the 3 million. So the company will be getting 1 million shares. Okay, these shares, the people will purchase it at what? How much? What is the offer price?
3.2.
3.2 per
Okay.
share.
Okay, 3.2. What will be the total? That will be 3,200, isn't it?
Yes.
What will be the total value of the shares of the company after the right issue? And what will be the total number of shares now? This will be 4 million.
4 million.
Okay, and this will be 15,200.
15.
Yeah, 15,200.
Okay. Then what will now be the value of a share after the right issue? How do we find the value of a share? The value per share or price per share? How do we find it after the right issue?
That's 15,000. 15,200,000 divided by.
Okay, so the total value of the company divided by the number of shares that they have, isn't it?
Yes. Yes.
What are they having? Is what?
1.3.
Are you sure? I'm getting 3.8.
Sorry, 3.8. Sorry.
3.8, yeah.
Okay. So this is a total approach. Okay. You see, mostly they teach the people the unit approach. You can go to the exam, they will not give you the unit approach. They will not give you the 143. The question will not give you 143. But the question will give you the money that you'll be realizing from the right issue, and they will ask you to find the number of shares that you are going to be issuing through the right issue. So they will not give you the 143. They can just give you total values. That's why mostly I do the two. So I'm going to be using the unit approach to also get the 3.8. Okay. So I'll be using the unit approach. The unit approach, what we do is that we look at the existing shares. Then you ask yourself, how many of the existing shares are you bringing? You can see that we are bringing 3 of the existing shares for 1 new, isn't it? Okay. So we bring only 3 over here, multiply by that. So this one, instead of us grossing it, we bring only 3, which is the 143. The last one will always be for the existing shares. The 1 over here is the new share. The 3 is the existing shares. And these shares are carried at 4 cedi. So that will give us 12. Then you come to the right issue. How many of the new shares are you getting? It's 1. And this one is at 3.2. So that will give you 3.2. So you'll be having, you have 4. Then you have a total of 15.2. So your theoretical XY price can be calculated as 15.2 divided by 4. That will still give you 3.8. So you can use any of them. Someone might choose the total approach method. Someone might choose the what? The unit approach method. Any of them that you are choosing, you will be correct. This is what we call the value of a share after the right issue is what we call the theoretical XY price. Okay, let's now count to value of a right. Okay, value of a right. If you are buying the shares, if you are buying the right, how much are you going to be buying it? How much are the shareholders buying the right? How much are they paying for the right issue? How much are they buying the right? How much are they buying the right?
3.2.
Okay, 3.2. But if they want to sell it, how much are they going to sell it now?
4.
No. What's the new price of the share?
3.8. Sorry, 3.8.
Okay. This one is before the right issue. After the right issue, this is now the new price of the shares, 3.8. You are buying the shares at 3.8. And if you want to sell it, you are buying the shares at 3.2. But if you want to sell it, you are selling it at 3.8. What is the profit that you are making?
0.6.
Okay.
0.6.
So the value of a right is calculated as the theoretical XY price minus the offer price. The offer price is just the right issue price. So that will give you 3.8 minus 3.2. And the value of a right is 0.6. Okay. So after knowing this, we can now take the question that they are asking us. We can now take what they are asking us. Okay. They say the person sells all the rights. The person sells all the rights. So let's take the person takes up all his rights first before we come to the sell all the rights. Assuming we are using that one. Okay. The shareholder is having how many shares? What is the number of shares that the shareholder is having?
900.
Okay. So the number of shares will be 900. Okay. So let's now come here. So let's look at the A. The person takes up all the rights. takes up all the rights. The person takes up all the rights. Okay. Okay. What we do first is that we do before the right issue and after the right issue. You show the effect, the two effects. So you show before the right issue. Before the right issue. Before the right issue, the person will be having what? What will be the total value of the shares for that person? That will be 900 multiplied by 4. Am I correct? The value of these shares before the right issue will be the 900 shares times what?
3,600.
Okay, that will be 3,600. Okay, let's now count to after the right issue. Okay, after the right issue, the person existing shares will no longer be 4 cedi. Okay, the existing shares will no longer be valued at 4 cedi. It will be valued at what?
3.8.
Okay.
You get 3,420.
3,000.
420.
Okay. So what will be the right issue? The person takes up all the rights. What will be the right issue? What will be the right that the person, how many shares will the person be getting if the right issue is 143 and the person has 900 shares? How many shares will the person be getting from the 900 if the right issue is 143?
300.
Okay.
300.
And this will be multiplied at what? 3.8. Okay. And what are we getting?
1,140.
Okay, what will be the total?
That's 4,560.
Okay. So you can also find the 4,460 by adding the 900 and 300. It means that your existing shares is 900, but you are buying additional shares to a right issue of 300. So the total will be 1,200. Then you just multiply by 3.8. But because I want to show the effect differently, that's why I'm bringing the right issue. You can just put the two together and multiply by the 3.8. Okay. Let's now count to the B part. Okay. Okay, the B part is that the person sells all the rights. They sells all the rights. Okay. Let's now come here. So sells sell all the rights. Okay. What you also do is that the effect will always be you do the before and after. Okay, that is how you be able to do the 3.8 is the theoretical XY price. So everything that we are doing over here is after the right issue. So the shares will now be measured at 3.8. Everything that we are doing over here is after the right issue. Okay, so if you count to the before, this person will be having the existing shares. There will not be any right issue. So the person will be having the existing shares of 900 times 4. That will be 3,600. Okay, let's now count to after the right issue. Okay, after the right issue, the existing shares will still be what? The existing shares will still be 900.
Yes.
Multiplied by 3.8, isn't it?
Yes.
That will give us 3,420. Okay, the person sells all the right, isn't it?
Yeah.
Okay. Okay, the person will be having a gain of, so the person will not be having any of the right issue in addition to their shares. No, they exercise the right and they sell it. So they bought the shares and they sell it again. So they will be having a gain on the sale of this. Okay. You see that they bought the shares 3.2, but they are selling it at what, 3.8, isn't it?
Yeah.
So the gain is always the value of a right. So they'll be having a gain, which will be 300 multiplied by 0.6. What are they having as a gain?
180.
Okay, 180. What will be the total now? It will still be 3,600.
Yeah.
Isn't it?
So yeah.
Yeah.
So can you just subtract the before from the 3,600, 3,420, then you get the 180.
It might be a coincidence. Okay. So I can't say yes to that one unless we are able to prove that particular point with so many examples. Okay. So it might be a coincidence. So the gain, since the people are selling, it means that they will buy at what? So someone can say that the 300, someone can do 300 times 3.8. Then we'll come and do 300 times 3.2. The 3.2 will be a purchase cost. So they will add 300 times 3.8. Then they will now come and subtract 300 times 3.2 because you buy before you what? You sell. You buy before you sell. So they will be having a gain of 180. Let's go to the next one. What is the next one? The next one is the exercise half and what? Sell the other half. So I hope right now we are following the before. The before will always be so 50%, 50%. So let's do 50%, 50%. That means they sell half and they keep half. Okay. So the before will still be the same value. Okay. Do I have to do that before again? Because it will be 3,600 and we have now understand how we do that before. So let's just do after. Okay. The after the existing shares will be what? 900 times 3.8. Are we okay with that one? 3420. Okay. Okay. What will be the remaining shares that will be? What will be the shares that will be remaining? They are selling half and keeping half. What is the number of shares that they are getting from the right issue?
300.
So they sell half. So the
So
remaining half will be
150.
okay.
150.
This 150 will be valued at what?
3.2.
No. It will be valued at the new shares now, the new value now, which is 3.8.
Okay.
This is what they will be having in the books of the company. So that will give us how much?
That's 570.
570. Okay. Then they will be having a gain on the what? On the other half.
Yeah.
Okay. So we have a gain. So that will be 150 times 0.6. I hope we are okay with the 150 times 0.6.
Yeah.
Okay.
Which is 90.
90. So the total value will be what?
$4,080.
Okay. 4080. The last one is what?
4,080, not for it.
Okay. 4080. The last one is what?
Takes no action. Do nothing
It's
at all.
okay. So whenever there is a right issue, whenever there is a right issue, the existing shareholder have so many options. The first one is they can decide to renounce their right. Renouncing your right means that you are selling it. You have taken up the right and you are selling it. Okay, they can decide to take up their right. They will take it up and they will decide not to sell it. They will keep it. They can also decide to do nothing. So these are those things that they are asking us are the options available for existing shareholder whenever there is a right issue. They can decide to do nothing. They can decide to renounce it by buying and selling all the rights. They can decide to take up all the rights. They can decide to exercise the rights and they will not sell it. They can also decide to take up some and renounce the sum. That is sell half and keep the other half, or sell 40% and keep the 60%. Okay. If this person is doing nothing, if this person is doing nothing, we have the existing shares. It will be 900 multiply by 4. That will give us 3,600. Okay. After, you can see that the person is not buying, is not exercising the right, so they will not buy any shares from the right issue. So that will be 900 multiplied by 3.8, 3420. Okay. So whenever there's a right issue, the shareholder who does nothing will be the one that will suffer. So if you are doing nothing, it means that you're not buying the rights, but your shares were first valued at 4, but now they will be valued at 3.8. It means that you are going to be suffering a loss of what? 0.2 per share after the right issue. That is basically about the right issue. Okay. Let's now start with the cost of capital. The cost of capital, you have to know that we know cost of capital, we do cost of equity, which can be calculated using 2 models. We use the dividend valuation model, dividend without growth, dividend with constant growth. We also use the asset pricing model. Okay. Then from that one, we go to cost of what? Debt. The cost of debt over here is only debt. Preference shares are not treated as debts if you are doing cost of what? Cost of capital. So we have 2 types of debts. We have irredeemable debts, debt that is having a debt up to perpetuity. Their interest payment is up to perpetuity. They don't have any maturity date. That's what we call the irredeemable debt. They will be with the company forever. How do we calculate their cost of equity? It's just the interest that we are paying to them over their market price times 100. But if there is a tax element, that the interest paid on the what? On the debt is tax deductible. So we find our after-tax interest. What is the actual amount that we are paying to them? We are paying 700, but the tax authority is giving us a tax benefit of 30% on that. It means that indirectly, we are paying only 70% of the amount to those people. So we look at the after-tax cost of debt. If you count redeemable debt, a debt that is having a maturity date, we use the internal rate of return to determine it. Then we count to convertible debts, we count to preference shares, we count to the weighted average cost of capital and other issues. So we pick this question, and I'll be using the question to explain other issues. So let's see how many questions do we have under cost of capital. Okay, at least we can be able to solve maybe 4 or 3. And then try with the business valuation. So let's try with the cost of capital. Okay, the first one. Who is taking it for us?
The equity beta of Fence Company is 0.9, and the company has issued 10 million ordinary shares. The market value of each ordinary share is 7.50 pesos. The company is also financed by 7% bonds with a nominal value of 100 cedis per bond, which will be redeemed in 7 years' time at nominal value. The bonds have a total nominal value of 14 million Ghana cedis. Interest on the bonds has just been paid, and the current market value of each bond is 107.14. Fence Company plans to invest in a project which is different to its existing business operations and has identified a company in the same business area as the project, Hex Company. The equity beta of Hex Company is 1.2, and the company has an equity market value of 54 million Ghana cedis. The market value of the debt of Hex Company is 12 million Ghana cedis. The risk-free rate of return is 4% per year, and the average return on the stock market is 11% per year. Both companies pay corporation tax at a rate of 20% per year required. Calculate the current weighted average cost of capital of Fence Company. Calculate cost of equity with the new project. And C, explain the difference between systematic and unsystematic risk in relation to portfolio theory and the capital asset pricing model.
Okay. So you can see that the company over here is a French school, isn't it? Okay, but they are also planning to undertake a project in a different industry, isn't it? That is what we call the diversification of what operations. That is where the gearing, the ungearing, and the regearing comes in. Okay, but before that, they are asking us to find the weighted average cost of capital. Okay, the weighted average cost of capital. So the question now is, what is the interest? What is the dividend that we are paying on the shares? What is the interest that we are paying on the debts? Okay. What is the portion of the total value that can give us the interest for the two? That is the weighted average cost of capital. So those, you see the work that you have been calculating under borrowing cost, IS 23, that is the same as the weighted average cost of capital. That is the calculation. But mostly FM, we don't want to bother ourselves with that. We just go straightforward with what? With formulas. So cost of capital. And we are looking at the first question, which is the French school. Okay. So we are looking at French school. So the question is asking us for WACC. How do we calculate WACC? WACC is calculated as VE over VE plus VD. So the VE and then the VD, they are all market values. They are all market values. So multiply by the cost of equity. Then you now do plus VD over VE plus VD multiplied by cost of debt. You can have loan, you add a loan. So this is based on the long-term capital structure of the company. So you can have preference shares. You add a preference shares to the down. So maybe you have preference shares, you can put the VF here. Then you expand the formula like that. But this case, we have only two. So what we need is that we need to find the value of the equity, which is the market value. Let's go to the question and see if we can be able to get the value of the equity. What is the number of shares that the company is having?
10 million.
Okay, 10 million. And the market value of each share is what?
750 pesos.
Okay, what will be the total value of the shares, which we call the market capitalization value?
75 million.
Okay, so we have 10 million shares multiplied by 7.5. So VE will give you 75 million shares. Okay, so it means that we need to find the KE. Okay, we count to the cost of the debt. Let's find the value of the debt before we count to the KE. Okay, so VD. Okay, let's now count to the VD. Okay, what do you have to know that debts are always bonds or debt instruments, debentures are always issued in units, and each unit is $100. But if you count to Ghana, is 100 cedis. So you have to know that the unit price for debt instruments are 100 cedis or $100. Okay, so that is the nominal value or the par value. Okay, let's come here. The company is also financed by 7% bond with a nominal value of 100 per bond, which will be redeemed in 7 years' time at nominal value. The bond had a total value of 14 million. Interest on the bond has just been paid, and the current market value of each bond is 107.14. Okay, let's come here. The bond has a total nominal value. Okay, the question is, the meaning is that we issued a certain unit of bond at 100 cedis, and the total value is now 14 million. Okay, so the question is, how many units of the instrument was issued? We issued a certain number of it, and at 100 cedis, and the total value is now what? 14 million. Okay, what will be the unit? How many units of the bond were issued?
That's 795, right? $140.
Okay, you have issued 140 what? Units of the bond, isn't it? Okay, So the unit that we issued is 140,000 units. Okay. But now they are saying that the current market value for the cost of capital, we use market values. So this 140 now has to be valued at 107.14. What are you getting? I'm getting 14.999.
Correct.
Is that correct?
Yeah, that's
Yes.
correct.
Can we say that
14.99 million.
okay,
Oh,
can we say the 14.99 that we have gotten is the same as 14 divided by 100 times 107.14? Can we say that?
yes.
Okay, the 14 is the unit that we are getting multiplied by this. Or you can also say that this is calculated as 107.14 divided by 100 multiplied by 14. That is also another way of calculating it. So if you want to calculate the current market value of the bond, it's just if you want to calculate total current market value, it's just the current market value divided by the nominal value times the total nominal value. That's how we get it. Very simple. Okay, so we can now have 107.14 divided by 100 times 14 million. Okay, we can approximate that to be 15 million, isn't it?
Yes.
Okay, so we have now gotten our VE and the VD. These are all at market value. What do we need? We need the cost of equity. We need the cost of what? Debt. How do we do that? Let's now count the cost of equity. The cost of equity, you look at the information given to you and decide on which of the models that you should use. Is it going to be capital asset pricing model? Is it going to be dividend valuation model? You can only use dividend valuation model when you are giving information on dividends. But if you are not giving information on dividends, you can also be giving information on the earnings per share and the dividend payout ratio. If you are not giving, then they will give you information on the return on the market or the equity risk premium. They will also give you information on the equity beta. They will give you information on the what? On the risk-free rate of return. The risk-free rate of return is always the government bond. We assume that a treasury bill is not having any risk because whatever happens, the government will still pay your money to you. But forget about the haircut or something. That is just an issue that will happen once in a while. The government securities, no matter what, they will find a way to pay you. So we say that there is no risk of you losing your investment. So they are risk-free. So if you are not giving the risk-free straightforward, they will give you an interest rate on a government security. Use that as the risk-free rate of return. All right, let's come here. Are we giving equity beta of Frenchco? Are we giving
Yes, please.
of
Yes,
French-
please. We're giving.
Okay. Are we giving the risk-free rate of return?
Yes, the risk-free is 4%.
Okay. Are you giving a return on the market?
Yeah, 11%.
Okay. So in this case, we can use our asset pricing model, which is the RF plus the beta, equity beta into bracket RM, which is the return on the market minus the risk-free. So our cost of equity is 4% plus 0.9 multiplied by what? 11% minus 4%. Are we okay? Okay.
Lance,
Yes, please.
I think the last sentence.
Okay.
So, in case we see a question and then it doesn't refer to the company you want to buy, is it a proxy or something? That means it's talking about the main company.
The risk-free that they're giving to you will be for all the two companies because that's the two companies are trading in the same market. They have their stock, not industry. They will have their instrument on the same stock exchange market. So these are the things that the returns are the things from the stock exchange market, not the individual companies.
Okay.
Okay. So you use it for the two companies. For the risk-free and those things, you use it for the two companies. Okay.
So when they are specific, then use it for that one.
When they are
Company,
specific, like the one relating to the
maybe
other.
friend school.
Okay, if they are specific that this is relating to friend school,
Yeah.
then use it for the friend school.
Friend school. Okay.
But if they just put it over there, it's something that will
It's
be
law.
yeah, that's it. Because the two companies are seen to be, although they are operating in the same different industry, they will be operating on the same stock exchange market, like the Ghana stock exchange market. Whether you are in the music industry, if you want to trade your equity shares, it will be on the stock exchange market. Okay. Let's come to, so what will be the cost of equity? 4% plus what? Sometimes they will give you equity risk premium. So the question can give you equity risk premium of 7%. The difference between the return on the market and then the risk-free is the equity risk premium. So sometimes they can just do these two and give you 7%. You don't have to do anything. You just bring the 7% and multiply it by the equity beta. Someone mentioned my name.
Sir, please, how did you get the 0.9 for the beta?
It is in the question. The start of the question, just read from the start. Have you seen it?
Yes, please, but I was seeing 1.2 somewhere. So that is what
1.2, read the 1.2 to the end.
the equity beta of Hex company is 1.2.
Okay, who are you finding the cost of the weighted average cost of capital for?
Friend school.
Okay, so you use the equity beta of friend school. Okay. Okay, the next time that you call me Sel, you are going to be having a problem because my name is not Sel. So if you call me Sel, whatever I'll be saying, you'll not be getting it. It's just automatic. It's by the grace of God. So just mention my name, Linus, or yes, because you can't mention my Ewe name, so it should be Linus. Okay. All right. So, Auntie, I won't call you Madam, so you shouldn't call me Sir. Okay, so just call me by my name, Linus. Fine. I hope you're on the same path.
Yes, please.
Okay, thank you very much. So what is the difference over here? 0.9 times what? Times 7%. I'm getting 6.3%. Is that correct? The total is 10.3.
Yeah, correct.
Okay. Let's now count to the KD, which is the what? The cost of what? The debt. The cost of debt. Okay. But this particular one is a redeemable what? This debt is a redeemable debt, isn't it?
Yeah.
So what we do now is that we use the internal rate of return. We use two guess rates. One of them should be giving us a positive NPV, and one of them should be giving us a negative what? NPV. Okay. What we have to do is that I always advise people to use the nominal rate attached to what? To the bond. What is the nominal rate attached to the bond?
7%.
Okay, so you start with the 7%, use the 7%. Okay, so what we do now is we have the years here, we have the cash flow, we have the discount factor, which will be 7%. Then we have the present value. So the first one is we will find the what? You see that there will be the instrument is now having what? A current market value. The present value of that particular amount is the same as 107.14. So we pick the cash inflows and then the cash outflows for the company. Okay. So we have year zero. Year zero, the cash flow will be the current market value because we are adjusting our amount that we are paying against this one. We are adjusting amount that we are paying against this one. This is done as if we are doing it for the what? The debt holder. If you are doing it for the debt holder, this will be an outflow for them. So the discount factor will be 1.00. So their present value will now be a negative because this is the amount that they are currently investing in the instrument. So this is an outflow for them. The instrument or the bond is having a current market value of 107.14. That is the amount that they are buying the bond. So it's just like initial investment. This is the initial investment for them. Okay. 1 to 7 years. Okay. This is redeemable in 7 years' time. Okay. 1 to 7 years, they will be receiving an interest of 7% on what? What will be the interest that they'll be receiving? What will be the interest that they'll be receiving every year?
7%.
7% after tax.
7% on the nominal value.
Okay, so that will give us 7, isn't it?
Yeah.
Okay,
Yes.
that is before tax.
Before
Isn't it?
tax.
Okay, so what do we do?
Yeah. You find the amount
After
and then
tax.
you deduct the tax from it.
Okay, so they will be receiving 80% of this amount because the tax rate is what?
20.
20%. Okay, so what are you going to be getting? 0.8 times 7.
5.6.
5.6.
The interest is always calculated on the nominal value. Even if you are not giving the 100, you calculate the interest on the 100 because all bonds or the debentures are assumed to be issued in what? In a unit of 100 cedis. So we find a unit value. What is the interest per unit? It will be the nominal rate times the nominal value or the par value. Okay. If they give you a tax rate, you find the after tax. So this will be 5.6, isn't it?
Yes.
But this will be received for 7 years. So we can use the annuity. So let's use annuity. 1 minus into bracket 1 plus R expo negative N all over R. And your R is 7%. At the end of the 7 year, the company will what? Will pay the 100. The redemption value does not attract tax. It's not allowable for tax purposes. So we don't charge tax on it. So at the end of the 7 year, this will be redeemed at par. The company will pay the 100 to them. So that will be an inflow to the what? To the holders of the bond. Okay. So let's find the annuity. What are we getting for the annuity?
5.389.
So 5.389. Okay, let's find a discount factor in the 7th year. 1 over 1 plus R exponent N, or 1 plus R exponent negative N. What are we getting? Please, we only use the annuity when the cash flow is constant. The interest will be constant for 7 years. That's why we are using annuity. But if you are receiving only one amount of money, we use a discount factor. You can say the 100 will be paid in what? 7 years' time. What is the today's value of the 100 cedis in 7 years' time? So the discount factor is what?
0.623.
0.623. So let's find the present value now. This will be 62.3. What will be for the interest?
Getting 30.18.
Okay, 30.18. Okay, so what will be the value that we'll be getting? Negative 14.
14.66.
Okay, so 7% is now giving us negative. How do? We need a positive NPV. Do we increase the rate or reduce the rate?
Reduce.
We reduce. Okay.
Reduce the rate.
Okay. So you will still be using the same cash flow. You have the years here, the cash flow. The discount factor, you can make it 4% or 3%. Okay. So you can use 4% or 3%. So you now count to year 0. You'll be using the same cash flows. So 107.14. But the discount factor will be different. So you'll be having 107.14. Okay. 1 to 7 will be 5.6. Then the discount factor will be different. Year 7 will be 100. So let's now find the annuity factor at 3% and the discount factor at. Please, the interest that you use will always be after tax interest because we want to find after tax. We want to find after tax cost of capital. Or someone can find the cost of capital and then come and adjust it by the tax rate. There's no problem with that. But it will be very okay for you if you use after tax interest. You can only use the 7 million if no tax rate is given to you. You don't have to assume any tax rate in the exam. If the tax rate is not given to you, use the full interest. But if it is given to you, you have to adjust it. Okay. Let's look at the annuity factor, 3%, 7 years. What are we getting?
6.230.
Okay, 6.230. Okay. The discount factor, what are you getting?
0.813.
0.813. So this will be 81.3. And this will be what? 5.6 times 6.
34.89.
Okay. 34.89. Let's add. Please, anytime that you are going to pick the rate, pick a reasonable rate. If you don't know you are picking 5% or 6%, you can still get negative. So pick a reasonable rate. If you don't know you are picking a rate and the difference between them is not that reasonable, if you get a positive first and you want to get negative, it will happen that you get positive again and you'll be frustrated. So you should pick a reasonable rate. A reasonable rate. Okay. What is the difference?
9.05.
9.05. Okay. So we can now go ahead to calculate our internal rate of return, which is the cost of what? Debt. So we look at the lowest rate. The formula is the lowest rate, okay, which is 3% plus the NPV of the lowest rate, 9.05, divided by the NPV of the lowest rate minus the NPV of the highest rate, which will be the positive, so 14.66. Then all of this multiplied by the difference between the rates. Okay, so our KD will be equal to 3% plus, what are we having? If you put the two together, 9.05 divided by is
23.71.
Okay, multiplied by 4%, isn't it?
It's 4%.
Okay.
Yeah.
Please multiply this before you add it to the 3%. Okay, you first do that before the other one. What is the total?
I'm getting 4.53.
4.53. Okay. Okay. So someone can confirm that.
Yeah, 4.53%.
Okay. So let's now come to the WACC. We can now go ahead with the WACC now. Only one WACC, see how you are suffering. So it will be 75 million divided by 75 million plus 15 million multiplied by the cost of equity, 10.3%. Okay. Then you put all of this one in one bracket. Then plus the debt, we have 15 divided by, I can now make it 90 multiplied by 4.53%. So you can just put all of them together and get a WACC. So 75 over 90 times 10.3%. plus 15 over 90 times 4.57. Okay. What are we having in total? What are we having as a total?
I having it on Friday, coming Friday this week.
Please, what are we having?
Hold on. 9.34.
9 points.
34.
Okay. That is the work. Okay. Let's also calculate the work using a different format. Okay. Okay. The work can also be calculated like this. Okay. You find the return on each of these amount, but the return will be calculated on their market values. So you look at the return on equity. So return on equity or the cost of equity in terms of money. Okay. Cost of equity in terms of money will be 10.3% multiplied by 75 million. What are we having? I'm having
Getting
7 points.
7, 10%. Sorry.
Okay. Let's count to the cost of the debt in terms of money terms. It will be 4.53% multiplied by 15 million.
So approximately 0.68.
Okay.
Or
Okay, 0.68. Okay, since we are keeping this one, let's put all of this one. So 0.6795. Okay, let's now look at the total return that we are paying. What is the total return? The total return will be 7.725 plus 0.795. What is the total? I'm having
8.4045.
Okay, and this particular return is charged on a total amount of what? So you look at the total amount. What is the amount giving you this particular return? You can see that we calculate it on equity 75 million, and we calculate it on a debt of 75 million, and that will give you 90 million. Okay, so the question now is, what rate of 90 million will give you the 8.258? 8.40 something, and that particular rate is what we call the work. So you now have 8.4045 divided by 90 million times 100. You should be getting something approximately 9.34 something. So you can also decide to, after looking for the cost of equity, you can decide not to use the formula. Then you just find the total return on the market value using their cost of capital. You can just use those one to find this particular value. Okay. So let's now come to the next part of this question. Okay. They say calculate a cost of equity which could be used in appraising the new projects. So what we do is that the company is going to be entering a different industry, which is not similar to their operations. So what we do is that if you're in the hospitality industry and you want to go to to the manufacturing industry, or you want to go to the music industry, you can see that these are two different operations. They are going to be having a different business risks. So we pick a company that is already in the music industry, use their financials to determine the asset beta. The asset beta is the business risks, is the beta that is consisting of only the business risk of that particular industry. So after we know the business risks, we can now factor in our financials to know our equity beta by putting in our financial risks. Then we now go ahead to use the beta to now calculate the cost of the equity for appraising the new project. So what we do is that we do what we call the engineering. So we look at Hensco. Okay, so we now use Hensco as the proxy company. The proxy company is the company that is operating in the industry that the company wants to undertake the investment in. That's what we call the proxy company. Okay, so we now look at the asset beta of the proxy company. How is the asset beta calculated? Okay, it's the same thing like the WACC, but this one we take into consideration the issues of debts. So we are going to be having VE over VE plus VD into bracket 1 minus T. That is, we are taking into consideration this one. So we now count to plus VD over VE plus into bracket. This will be multiplied by the equity beta, the equity beta of the company. So let me take this one off. Let me do it very well. So we have times this one, then plus the VD over VE plus VD into bracket 1 minus T multiplied by the VD. But the problem is we assume that debt is risk-free. So their equity beta is 0. So their risk level is 0. So we have all of this place to be 0. So the asset beta is only centered on the equity value. So VE over the VE plus VD into bracket 1 minus T multiplied by the equity beta. But which company's financial do we use? We use the proxy company, which will be the Hensco. So let's go to the question over there and look at issues about the Hensco. Okay, what is the equity value of Hensco? The Hensco, okay, Hensco. What is the equity value of
1.2.
The equity value, not the equity beta.
Value. Sorry.
Okay.
54 million.
Okay, the equity value is 54 million. Okay, sometimes the question can ask you to calculate that. They will give you the number of their shares and they will give you their market value. So you have to do that. So 54 over what? 54 plus the debt. The debt component is what?
$12 million.
Okay. So by the debt, what you do is you do it after tax. Multiplied by their equity beta is 1.2. Okay. So let's do it. The asset beta of the industry.
Hello, sorry.
Yes,
The
please.
tax rate is 20%.
Okay. Sorry. So it's supposed to be 1 minus 0.
20 to 0.
Okay. So I'm doing. Okay. So 1 minus 0.2. So let's now find it down. What are we having? 0.8 times 12 plus 54.
Getting 63.6.
If you add a 2.
Yes.
Okay. Okay, 63.6. Okay. Then you now multiply by the equity beta. What are we having? I'm having 1.02.
Yes, 1.02.
Okay. So this is the asset beta. The asset beta is the business risks of the industry that the company wants to operate in. So the company will now use the asset beta to now calculate their equity beta. So we do the reversal of this one. So the company will now calculate the firm school will now calculate their equity beta by using the same thing, but they will now change it. It will now be VE plus VD into bracket 1 minus T divided by the VE multiplied by the asset beta that we have calculated. So what we do is that we just change this particular, we are looking for this beta now. So we make the beta the subject. It means that we are going to be turning this particular upside down. That is how we go about it. Okay. So we use the beta. We now find a beta by using 75 plus 15 million. We now use the financials of the company itself. After finding the asset beta, we now find the equity beta of the company by using their financials. So their equity value was 75 million. Their debt value was 15 million. So this will now be 1 minus 0.2. Then all divided by 75 times 1.02. Okay. Put all together and give me the answer. Straightforward.
I got 1.1.
Okay, I'm also getting 1.18, isn't it?
Yeah, 1.1832.
Okay. So this is not the equity beta. So this is the beta that you'll be using to find your cost of equity. So the cost of equity, you will still be using your capital asset pricing model, but the equity beta will now be 1.18, the new equity beta that I have calculated. So this will be the cost of equity for the new project. So 4% plus 1.18 multiplied by 7%. So you still be using the same CAPM, but you'll be using the new what? Equity beta now. Because this is now associated with what? With the project that you want to undertake. So we use the equity beta to now find the cost of or the rate of return on the project. The 0.9 is on the existing project, the industry that the company is operating in. Now you are going to be investing in a different company, which is having an equity beta of 1.8. So what will be the thing that you'll be expecting? Okay.
12.6%.
12.6%.
Yeah.
Okay, so that is the cost of the appraising the new project. This is the return that we'll be using.
Okay, Linus.
Yes, please.
So in relation to the earlier theory that we did, the aggressive and then the defensive.
Yes, so this will be.
So can we say that the beta is what? The 1.18 is what? The aggressive.
Yeah, the investment is aggressive. It's an aggressive one. Yeah.
Then the 1.02, can we say is
it's also aggressive.
It's also because it's above 1.
Yes, please.
Okay.
It will be the 0.9 that they will say it is defensive. Somehow defensive, yeah. Okay. Let's go to the next one. Explain the difference between systematic and unsystematic risks in relation to portfolio theory and capital asset pricing model. What do we call systematic risks and unsystematic risks? What is the difference? Please, at least we should be able to finish with cost of capital, at least 3 questions. Then tomorrow we start with business valuation and the time value of money. I will say, yes. So after the time value of money, financial risk management, investments appraiser, and okay, working capital management. Let's see how we can go. What is systematic risk? Okay.
Minus.
Yes, please.
Yes. So when it comes to the systematic risk,
okay,
it has to do with the risks inherent to the entire market or
okay,
the segment.
okay, Okay.
and it cannot be diversified in any way.
Okay.
But with the unsystematic, it's just relate to the specific company or industry.
Okay. Okay.
That's my opinion.
Yeah. That your opinion is right. That is all. So systematic risks is affecting all that instruments on the stock exchange market. So anytime that you are having shares, the shares, either it is from this company or the other company, those particular shares will be having the same level of risk. That is the systematic risk. But the risk that is affecting the securities of a particular company is what we call the unsystematic risk. And this one, you can avoid it by what? Deciding not to invest in the securities of that particular company. You can go and invest in other securities. You are going to be avoiding it. But for the systematic risks, you cannot avoid it. The only way you can avoid it is that you don't want to invest at all. You don't want to have anything to do with the industry at all or the instruments at all. But if you are investing in the securities of Mawako Limited or Ghana Guinness, since the risk is systematic, you'll be facing the same level of risk despite the industry that you are investing or despite the securities of the company that you are investing in. The risk is affecting the whole securities in the market or stock exchange market. Okay. So that is the systematic and then the unsystematic risks. Systematic risk cannot be diversified, but unsystematic risk can be diversified. It can be diversified by the company spreading its investment among so many portfolios, investment portfolios, or the company will decide not to invest in the securities of that particular company and will sell their investments elsewhere. All right. So it's just like if you come to the Ghana music industry, mostly I use the Ghana music industry. Some of the artists, they don't have managers. Okay. So if it is a general problem for the Ghana music industry that artists doesn't have managers, they don't have managers. Okay. It means that even if you invest in the craft of Black Sherif, you will still be facing the risks of Black Sherif not having a manager. If you're not having a manager, it means that you will not be going for interviews and those things. So the risk of you not having a manager, you are also going to be facing it. Even if you invest in the craft of Shatawale, because that is the risk affecting all the artists in the Ghana music industry. But if it is only few of the artists that are not having managers, you can decide to avoid that risk by investing in what artists that are having managers. That particular risk will be unsystematic because it is specific to a particular artist or a group of artists, which you can decide not to invest in them and invest in other artists. That is the systematic and the unsystematic. All right. Let's take the question 2. Okay, the question 2. Then we look at question 3. Then let's see whether we can do with the question 4 too and move on. Okay. Some of the questions I'll be leaving them for you to try. Okay, let's look at question 2. Who can take that one for us?
Okay, let me do it. Question 2. LDK Limited wants to raise 150,000 Ghana cedis additional funds to undertake an expansion of its operations. Its current capital structure is as follows: 1 million ordinary shares, 5 million, 1.6 debenture. It is estimated that cost of equity is 15%. In raising the additional capital, the company is considering 2 options. A, raise 75,000 of equity finance and 75,000 finance. B, raise 150,000 of debt finance, in which the cost of equity will increase by 5%. Required: recommend the best option LDK Limited should adopt. Assume a corporate tax of 25%.
Okay. So how do you think you should answer this question? Should be answered, assuming this question has been asked in the exam. How do you go about it? Is a question about what?
WACC.
It's a question about WACC. Okay. It's a question about WACC. So you find your weighted average cost of capital before raising the what? The new finance. What is the existing WACC now? Then if you decide to raise the finance through equity, what is the option? What is the WACC now? If you decide to take it through debt, what is the WACC now? That's what we do. So this question is about WACC, or someone can say it's about capital structure. Someone can say it's about capital structure. So you look at your capital structure, maybe after the first issue, or what is the existing capital structure? And what is the capital structure if you are using equity? What is the capital structure if you are using this? But WACC will be the best one to be used to answer this question. So what you have to do is that you have to find the existing WACC. How do we find the existing WACC? How do we find the existing WACC? How do we find the existing WACC? Sinners. We have to know the fair values, the market values of the shares and the debentures, isn't it? Then we look for their cost of capital too. Okay. Okay. So question 2. Let's look at the WACC, the existing WACC. VE over VE plus VD multiplied by KE plus VD over VE plus VD multiplied by KD. Okay. How do we find the VE from this particular question? How do we calculate the VE?
So you multiply your 50 pesos times the 1 million shares.
That will give us how much? So 0.5.
So using 1,000, I'm getting 500.
Okay,
1
so
million, I'm using hanging 3 zeros. So
okay. So let's make it 2,000, isn't it?
yeah.
Okay. So it will be the market value multiplied by the number of shares. Let's go to VE. How do we get a VE? The VD rather.
So the VD, use your market value, which is 0.1, divided by the nominal value 1 cedi, times the book value, which is 5 million.
Okay. So you can see that one too, we are just multiplying by, we're just 0.1 divided by 1 will still give us a 0.1. So multiply by 5,000. What are we getting?
500.
Okay. Okay, so we have 0.1 times 5,000 over 1. That will give us 500. Our cost of equity is given to us to be 15%, isn't it? Okay. How do we find the cost of debt? Okay. How do we find the cost of debt? So this one, nothing, they haven't said anything about the debenture. So you assume that the debenture is irredeemable. So if it is irredeemable, you find the interest into bracket 1 minus T over the X interest price multiplied by 100. Okay. So let's look at the interest. What is the interest? The interest will always be calculated on the nominal value, which is 1 day. So the interest is always calculated on the nominal value, which is 1 day. So what will be the interest? the nominal interest rate, which is 1.16 divided by 100 times 1. What are you having? The interest will be 1.6% multiplied by the nominal value of 1. What are you having? I'm having 0.016 into brackets 1 minus 0.25. Okay, divided by the market value of 0.5 times 100. Please, what are we getting? So KD will give us 0.012 divided by 0.5 times 100. Okay, so 0.5 times 100. I'm getting 2.4%. Someone should confirm that for me, or we are lost. Please, can someone confirm the 2.4 for me?
Yes. Yes.
Okay. All right. So can we now go ahead to find a WACC? So our existing WACC, we are finding the existing WACC. It will be 500 divided by 1,000 because 500 plus 500 multiplied by the cost of equity now is 15%. Okay. Then you now do plus 500 over 1,000 multiplied by 2.4%. What will be the existing WACC?
Linus,
Yes, please.
please, the cost of debt, the X interest, why are you using the 0.5 instead of the 0.1?
Is it 0.1 or 0.5?
I'm seeing 0.5. That one is for the ordinary shares.
Okay, okay. Sorry, it's
checking.
supposed to be 0.5. Sorry. Thank you very much, Senior. It seems like it's only one person who is active here. The rest are watching stars. Okay.
The Linus,
Yes, please.
please can you go over the calculation for the cost of debt? Like I'm confused.
Adam, so is it 12%?
Yes. Yeah, 12%.
Okay.
So I was asking, I got down, but I thought I was on mute, so when I came
Okay.
back.
So it's supposed to be 12%. Okay. Yeah, someone say something.
Please, I said, can you go over the calculation for the cost of debt again?
Okay. All right. So nothing, the debt can be redeemable or irredeemable. If nothing is being said, then you assume that the debt is irredeemable. So if it is irredeemable, how do we calculate it? It is the after-tax interest divided by the current market price of the debt times 100. So how do we calculate the interest? The interest is calculated using the nominal interest rate, which is 1.6 multiplied by the nominal value of 1 cedi. And that will give you 0.016. Then we find after tax by putting into brackets 1 minus 0.25. You'll be getting the 0. Then your market value is 0.1. So you now bring your interest over here, which is the figure that I've gotten over here, divided by 0.1. Then for that place, you just do the division and multiply the answer by 100. That is all. Okay. Assuming the nominal value is not given to you as 1 cedi, you find the interest on 100. But this one, they have given you 1 cedi, so you use the nominal value of 1 cedi. So Adam, what are we having? I'm having 7.5% plus 6%. That will give me 13.5%. Is that correct? Is that correct? Can someone confirm the 13.5% for me? Okay. So let's now look at option 1. The company want to raise finance and they want to use these particular issues. Okay. It is estimated the cost of equity to be 15%. In raising the additional capital, the company is considering 2 options. Okay. A, raise 75,000 of equity shares and 75,000 of debt finance. Okay. So what they are saying is that, you see, the new issues that will be coming, they'll be having the same features like the debt. So the debt, the cost of the debt will still be the 12%, unless the question is giving you a different interest rate. The nominal rate will still be the same, and the interest rate will still be 1.6%, and the market value will still be 0.1. So the cost of debt will still be the same, and the return on equity also will still be the same. It will be 15%. But what is going to be changing is their capitals. Okay, you can see that we are using 3 zeros. We are keeping 3 zeros for each of them. So what will come now is that our market value for equity now, the WACC, the market value for equity now will be 500 plus the new equity. So it will be 500 plus the new equity divided by the 1,000 that we have first plus the 150, because the capital of the company will now be increasing by what? 150. This 150 will be half. Equity will take half, debt will also take half. Then you now do multiply by 15%. Their cost of capital will still be the same because they will be following the same return and the same everything. The dividend payment will still follow the same pattern, and the market price will still be the same pattern. So the cost of equity will still be the same. The cost of equity is going to be the same. Okay. And the cost of debt will also be the same because it will be issued at the same nominal value and the same market value. So what you do over here is that plus 575 divided by 10. Okay, divided by 1150. 1150 times 12%. Okay, so 575 divided by 1150 times 15%. Okay, I'm still having 7.5% plus 575 divided by 1150 times 12%. Okay, this will still be 6%. So that will still be, the WACC will still be 13.5%. So you can see that if you're using 50-50, the WACC will still be the same. The WACC will still be the same. There will not be any effect on the WACC if the cost of capital are the same. Let's look at the option 2. Option 2. Option 2. Okay, option 2. Let's look at the WACC for option 2. Okay, so the option 2, which source are they using?
Debt.
Okay, so they are taking all the 150 through debt, isn't it? Okay, so the equity will still be 500. So 500 divided by 1150. The cost of equity will increase by what?
5%.
So it means that the new cost of equity will be what?
15.75.
Okay. Don't go and add the 5 to, don't go and add the, don't go and add the 5 to the 15. No. They say the cost will now increase by 5%. Okay. It depends on how you
so I did
understand.
it 1.05 times 15.
Okay. So it depends on how you understand it. If they say the cost of equity will now increase by 5%, it doesn't mean that it will you add a 5% to the 15% to now make it what 20%. No. The existing cost of equity will now increase by 5%. That is what they mean. Okay, it depends on how you understand it. So don't go and add the 5% to the 15 and now have what 20%. No. The existing now will increase by 5%. So you just do 1.05 times the 15. I'm having 15.75%. Okay.
Yes.
15.75%. Okay. So the cost of equity will increase by 5%. What is increasing? It is the existing one that is increasing by 5%. Okay. If you go and add, you are on your own. Okay, 650 divided by 1150 times the 12%. What are we having now? What will be the new WACC?
Getting 13.63.
13.
0.63.
Okay. 13.63. Okay, which of the options are you going to be using?
I'll stick to option A.
Okay, we use the option 1 because it has no effect on what?
On our capital.
Okay, it has no effect on our capital. Okay, but the second one is having an effect on what? On our WACC. This support the idea of the traditional view of capital structure. So the traditional view of capital structure is saying that whenever a debt is issued and the debt is cheap, the cost of capital will always what? The benefit that you'll be getting on a cheap debt will always cancel out the increase that you'll be having in the cost of equity. Okay, so you can see that the WACC is still the same for the option A, but you come to option 2, the WACC is now 13.63. It has increased by 0.013 or something. Okay, so you will stick with the one with the what? With the WACC being the same or the WACC being slightly different. This one you are just using figures. So you pick the one that will give you the lowest what option. That is about that one. Let's pick the question 3. Then we know that. Let me see whether tomorrow we can do. Tomorrow we can do business valuation in the time value of money. Okay. So tomorrow if we do this one, then we do financial risk management and investment appraisal. Investment appraisal. Okay. Right. We can still finish before the. So tomorrow we try time value of money and business valuation. Then the next one will be financial risk management and part of the investment appraisal. So that Friday we do investment appraisal and working capital management. Okay. Okay, let's pick the question 3. Who is taking it for us?
Okay,
Question 3. The new company has a dividend payout ratio of 40% and has maintained this payout ratio for several years. The current dividend per share of the company is 50 Ghana pesos per share, and it expects that its next dividend per share, payable in 1 year's time, will be 52 Ghana pesos per share. The capital structure of the company is as follows. Equity, ordinary share, 25 million Ghana cedis. Reserves, 35 million Ghana cedis. Can you scroll for me?
Okay.
450,000. What are the other costs?
Debt, bond A, 20 million Ghana cedis. Bond B, 10 million Ghana cedis. Bond A will be redeemed at par in 10 years' time and pays annual interest of 9%. The current ex-interest market price of the bond is 95.08 Ghana cedis. Bond B will be redeemed at par in 4 years' time and pays annual interest of 8%. The cost of debt of this bond is 7.82% per year. The current ex-interest market price of the bond is 102.01 Ghana cedis. Bond A and Bond B were issued at the same time. The new company has an equity beta of 1.2. The risk-free rate of return is 4% per year, and the average return on the market of 11% per year. Ignore taxation. Required. Calculate the cost of debt of bond A. B. Calculate the following values for the new company limited. Cost of equity using the capital asset pricing model. Capital gearing, that's debt dividend divided by debt plus equity using market values and values and market value weighted average cost of capital.
All right. Thank you. All right. Okay. So the company has a dividend payout ratio of 40% and has maintained this payout ratio for several years. The current dividend per share of the company is what? It's 50 pesos per share, and it's expected that its next dividend per share payable in 1 year's time will be 52 pesos per share. Okay. Okay. Let's come here. Bond A will be redeemed at par in 10 years' time and pays annual interest of 9%. The current SDF market price of the bond is 95.08. Bond B will be redeemed at par in 4 years' time and pays annual interest of 8%. The cost of debt of this bond is 7.82 per year. Okay. The current SDF market price of the bond is 102.01. Bond A and Bond B were issued at the same time. The company is having equity beta, the risk-free rate, and all these things there. Okay. What are they asking us? The first thing that they're asking us is what? We should find the cost of debt. What? We should find the cost of debt of bond A. How do we do that? Bond A, is it redeemable or irredeemable?
It's redeemable.
Redeemable.
So what do we do?
You calculate our MPV, and then use to find the IRR.
Okay. 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 So question 3, we calculate, we now look for the A, the KD of bond A. The KD of bond A. Okay. The KD of bond A. So what do we do is that we have the years, we have the cash flow, we have the discount factor, then we have the present value. The discount factor, which one are we going to use first? 9%, which is the nominal value, isn't it? Okay. This will be redeemed in how many years' time?
10.
Okay, and the market price is what?
95.08.
Okay, so we have 95.08 as an outflow. So we have 0.1. So 95.08 as this. So year 1 to year 10, that will be the interest. Interest will be paid for what? 10 years. So what will be the interest on this particular? What is the coupon?
9C.
Okay, they say we should ignore what? Taxation. So
Tax.
there will not be any tax issue there. There will be 90 days. Okay, at the end of the 10th year, they will pay the what? The nominal value.
Nominal value.
Okay. So what will be the annuity factor for 10 years at 9%?
9% of those. Wow. Getting 6.418.
6.418.
Yeah.
Okay. What about the discount factor in the 10th year?
Zero point 422.
0.422. So let's find the totals. Nine times 6.148. I'm getting 55.33.
Yes.
Okay. And this will be 42.2. What will be the closing balance?
The NPV is 2.45 positive.
Okay. 2.45. 2.45 positive. What do we do next?
We increase the discount factor to find the negative NPV.
Okay.
15%.
Okay. So
I still want the requirement.
which interest rate are we going to be using?
15%.
15 is too much.
Uh,
We can use 12. Okay, because the distance is 2.45, so it's not that much. Okay, so we have 9.08. We have 1.00. And this will still be 9.08. Then we come to year 1 to 10. We have 9 cedi. Then we come to 10. We have 100 cedis. What will be the discount factors?
$5.650.
Okay, 5.650. Last year is what? The 10th year is what?
Zero point three 322.
Okay, so this will be 32.2. The interest will be what? 9 times 5.65.
50.1.
15.85. What is the difference?
81. 50.81.
50.81.
Yes. Negative 12.07.
Okay, let's now look at the KD now. So we look at the lowest rate, which is 9%, plus the 2.45 divided by 2.45 plus 12.07, all multiplied by 12%, and there's 9%. What are we having in total? Just put the total together and give me the answer.
Okay, so 9 plus 5.
When the commission realized that
Getting 2.02.
2. Are you sure? Is it the last one?
Oh, done. Okay. 9.5, sorry. 12 minus this into brackets, yes.
9.5.
Yeah.
Okay. All right. So that is the first part. Let's look at the second part. What are they doing then?
The B.
Yeah. Calculate the
Calculate
following
the following values for Deno company.
Okay.
Cost of equity using the CAPM.
Okay. So let's come here. Can we do that using the CAPM? Do you have all the information for the CAPM? Okay, you can see that we have the equity beta, the risk-free, and then the return on the market. So let's calculate that.
Yes.
Using the CAPM. So cost of equity will give us the R rate, the RF plus the beta multiplied by RM minus the RF. Okay, so we have the 4%, 4% plus 1.2. Is it 1.2 or 1.12? Okay, 1.2 into bracket 11% minus what? 4%. So KE is equal to 4% plus 1.2 multiplied by 7%. In all, what are we getting?
Twelve point four.
12.4.
Okay, 12.4%. Okay. The next one is what?
Capital gearing.
Okay. They are saying that we should
Using-
calculate the capital gearing using market values, isn't it? Okay. How do we calculate the market value of bond A and bond B? You can see that you are giving their market value. Those are all per unit. And you are giving their nominal value in the statement of financial position also. So bond A is having a nominal value of 20 million. And the bond B is having a nominal value of 10 million. How do we find the market value for each of them? So let's count to the VD, which will be the bond A. That will give us, what is the market value for them? It's
20 million.
Okay. It's 95.08 divided by 100 times the 20 million. Is that correct? Let me go there again. Okay. The total value is 20 million and they are issued at a unit and 1 unit is 100 Ghana cedis. So if you want to find a unit, it will be the 20 million divided by 100. That will be the number of units. 1 unit is now 95.08. You just multiply. It's just like the way we calculate it under the WACC, which is the VD. So it will be the current market price divided by the nominal value multiplied by the total nominal value. So you have the 95.08 minus divided by the 100 multiplied by the 20. That is the first one. Let's count to VD for the B. So what you do is the current market value now. The current market value is 102.01 divided by 100 multiplied by the total nominal value of 10 million. What are we getting for each of them? That's how we calculate the market value. So their market value today is just this. So 95.08 divided by 100.
19.02.
Okay. So 19.02 million. Okay. For B, will give us what? Getting 10.20. $10.20. Is that correct?
Yes, it's correct.
Okay. But they say it should be debt. The capital generation should be debt over equity plus what? Plus debt, isn't it? Multiplied
Yes.
by 100. Now we know the debt values. Do we know the market value of the equity? Do we know the market value of the equity?
Yes.
The current market value of the equity, do we know it?
It's,
Are you talking about 25 million?
I want to see the number of shares if it was given.
The number of
If it's
shares
not
is
given.
20. The number of shares is 25 million because one share is 1 cedi per value.
Okay, I see.
Okay. But the current market value of the shares, the 25 million over there is based on a nominal value. So we are not giving the current market value of the share. So we have to find that ourselves. We have to find the current market value of the share ourselves using the dividend valuation model. So we have to now look at how we find the value of a share using the dividend valuation model. So we have to find the value of our share using the dividend valuation model. Okay, because they have given us information on the dividends. They have given us information on the dividends. So for us to know the market value of the equity, we first of all have to know the SDF market value of the share as at today. And we are not giving, so we have to determine that ourselves. We are only giving the value of the debt, which we have calculated their current market value. But we have to now do that of so let's count the value, the market value of the equity. We know that.
Sir,
Yes, please.
isn't it in the 60 million? The 60?
60 million, where?
When you go back to the question, the
This-
value of the equity.
These values are the equity that we use over here. Reserves is not part. We are using the value of the equity itself. And the equity is 25 million over there is based on 1 million.
Okay.
So we use market values. What is the market value of the equity? You can only find the market value if you are able to. So we know that this is into bracket 1 plus G over PO or plus G. So we are now looking for the PO. Looking for the PO, we have the DO into bracket 1 plus G over PE minus G. That's how we find the value. But let's now go and see our dividends. Are we giving information on the dividends? The current dividend per share is what? 50 pesos. And it's expected that its next dividend per share payable in 1 year's time will be 52 pesos per share. Okay. So the question now is, our current dividend is what? Is 50. The next dividend will be 52. What is now the growth in the dividend? What will be the growth in the dividend? Someone should tell me the growth. What will be the growth in the dividend?
It's 2 pesos.
In terms of percentage.
Percentage.
Yeah.
Zero 0.04.
Okay, that will be 4%, isn't it?
4%, yeah.
Okay. That is also calculated as the. So that is just you just find the difference over the 50 multiplied by 100, or you can do 52 over 50 minus 1. The answer multiplied by 100. Okay. The dividend that we normally use over here is the next year's dividend. So we have the PO is equal. Someone can decide to bring the 52 over here, or someone can decide to bring the current dividend over here. Then the person will increase it by 0.04. Okay. Then divided by, what is the cost of equity that we have calculated? What was the cost of equity calculated?
12.4.
12.4.
Okay, so we can have 0.124, then minus what? 0.04. Okay, what are we getting? It will be 52 divided by 0.084. What are we having as the value?
Getting 619.05.
Five seconds.
Hey, the 50, it should be 52 pesos. So 0.52.
Sorry.
All right.
Okay, so 60 is 19 pesos.
Okay. So it means that you are getting the answer in pesos. The one that you have calculated is in pesos. So you do it in Ghana cedi. So 0.084. So can we say that is 6.2?
Yes.
Okay. So 6.2 pesos. Okay, let's now go to our. Let's now go.
Is it 62 pesos or 6.2 pesos?
No, it's 6 series 20 pesos.
6 is 20 pesos.
Okay. Someone can also find. Let's now count to the VE. The VE now will be 6.20 multiplied by 25 million shares. Okay, because the shares that we are having now is the total value of the shares is 25 and one share is 1 cedi. It means that we have issued 25 million shares at 1 cedi and we are getting 25 million. Okay, someone can also calculate this figure like this. Okay, let's now look at this figure. What are we having? 6.2 multiplied by 25.
155.
Okay, 155. Okay, someone can also calculate the 155 like this. So the PO is equal to, the person will use total dividend instead of, the dividend per share. So the total dividend will be 0.5 multiplied by 25. So if you are paying 50 pesos per share and the total number of shares is 25. So it will be 0.5 multiplied by the 25. And the person will be having 12.5 into brackets 1.04, all divided by the 0.084. Okay. Okay. So the person will be getting 154.76, approximately the 155. So sometimes you can use the total dividend. If you use the total dividend, the answer that you'll be getting straightforward will just be the total market capitalization rate of the company. But let's just use these ones and move on. Okay. Let's just use these ones and move on. Okay. So let's now come to our capital gearing now. Our capital gearing will now be the total value of the debt because we have two debts. So 19.02 plus 10.20 divided by, so let's just add the two so that I will not have plenty issues there. So 19.02 plus 10.20. I'm having 29.22. Okay, divided by 155, which is the equity plus 29.22. All this multiplied by 100. Okay, so plus 155. So 29.22 divided by 184.22 multiplied by 100. What are we having? I'm having 15.86. Is that confirmed?
Linus, why are we not adding the reserve to the equity?
I'm coming. Oh, sorry. They say we should use market values, isn't it?
Yes.
Okay, so it means that the reserve is not part.
Okay.
All right. All right. But in actual sense, it should be shareholders fund. Okay. That should be
Shareholders fund.
shareholders fund, yeah. But since they are using equity fair values, we just use the equity, just use the fair value of the equity. Okay. The last one, what are we finding?
Market value weighted average cost of capital.
Okay. So this one is, we have done all these things already, isn't it? We have find the cost of, debt for each of them. So our work, we can just go forward, straightforward for the work. Okay. So our work will be VE over VE plus VD. But you see that the VD will be 2, isn't it? So we do.
Yeah. Bond A, bond B.
Okay. So what I'll do is that I'll just do this one. Let me just write the work at the top so that I'll have space to write the 2. So I'll have VE divided by VE plus VD plus VD. So 1, 2. Okay. So times KE into bracket this one plus. Please, can we just write their figures and move on? Because maybe I will not have space to write all of them. VD1 over VE plus VD1 plus VD2. Okay, multiplied by KD1 plus VD2 over VE plus VD1 plus VD2 multiplied by VD2. Okay. So what was the value for what was the value for the equity that we have gotten? 155, isn't it? Okay.
Yeah.
Divided by 184.22. I hope we know how we got the 18. This one we add all of them. The equity, the debt, the 2 debts. That's how can we got that one plus 12.4% for the equity. That is the cost of the equity that we have gotten. Then plus the debt. The first one was 19.02 divided by 184.22 multiplied by what was the cost of debt for the first one. We have done that for the first one. It was 9.5. Okay, so that would be 9.5%. Okay, plus the plus the next one is what? Okay, 10.20. So 10.20 divided by 1822 multiplied by the cost of that one. It is given in the question. Can you see it? The cost of the second one is given to us. The cost of debt of this bond is 7.82 per year. Okay, so that
Yes.
one is given in the question. So 7.82. So just put all of them together and write the final answer over there. That is all. At least 4 steps is okay. Please let's finish this one and take the question 4 so that you try the last one on your own. Please, what are we getting?
$11.85.
11.85. Okay. Let's take the last one. Let's take the last question 4.
Question 4.
No.
Ohio Limited is an equity finance company with a cost of capital of 18.5%. The risk-free rate is 8%, and the expected return on average market portion is 15%. The company is considering the following capital investment projects. Project 1, 2, 3. Then they have the initial capital out, the expected outflow, expected inflow for 1 year, and then the beta required. Calculate Ohio beta factor. B, calculate the CAPM required return for each project. C, if the company decided to invest 40% in project 1, 30% in project 2, and 30% in project 3, what will be the weighted average beta for the new investment?
Okay.
Interesting.
Is that?
So the question is interesting.
It's very simple. Okay. They say you should calculate the what that is the name of the company. Okay. You should calculate
The Ohio.
Ohio or Ohio beta factor. Do you know how you can calculate that?
You do the reverse.
Reverse of what? I'm asking you a question, you're asking me a question again. Adam, who does that? Reverse of what? It seems like you are the only active person in this meeting. Oh. Okay. The rest are saying that they are either sleeping or they are not seeing top. Anyhow of them, or any of them is okay. All right. The FM is just if your mathematics is strong, that is all. If your mathematics is not strong, then we have a problem. And the way you think too, your thinking level should also be on top of issues. How should you find the issues? Okay. Look, if you read the top there, you can see that you are
have
giving.
your KE already.
Okay, you have your cost of equity already, isn't it?
You have your risk-free, and then you have your return on market.
Okay.
So we do the change of subject, and then we find the beta.
Okay. That is all. Okay. So what you do is, and this was a question I've given to people in the mock, and they are saying that the question is difficult. What is difficult about this?
Me the mock. I was writing, I wasn't seeing top, and I stopped.
The question that we have solved from the beginning up to right now, they are all the more questions.
Then what happened? What was happening to me, Charlie?
The cost of capital for the first one, the one that we did one, the cost of capital questions that all we have done right now, they are all the more questions. So I don't know why people say that they are not seeing top because we are not reading.
Yeah, someone.
The first school is the pre-mock. The one that we did the work, that they say they are doing the finance and those ones is also the pre-mock. The one that we have solved right now is the final mock. The one that we are going to solve is also the final mock. So I don't know. Ayo. So let's come here. Cost of equity is equal to risk-free plus beta factor into brackets. The return on market minus what? The risk-free. Okay. So what is the cost of equity there? It's 18.5, isn't it?
Yes.
The risk-free is what?
8%.
8%. We don't know our beta, isn't it? So you put the beta there. Our return on the market is what?
Expected return, 15%.
15%. Okay. Minus 8%, isn't it? Okay. We are going to be having 18.5%. 18.5% is equal to 8% plus beta factor multiplied by 7%. Are you okay?
So your beta.
So we can say that we are going to be having 18.5 minus 8%. Change of subject. Grouping of items. Then we now have beta multiplied by 7%. We have 10.5% is equal to beta multiplied by 7%. So we divide both sides by 7%. We divide both sides by 7%. What are we having as the beta?
Get 1.5. No, that's correct.
Maybe 1.5.
Yes.
Okay, that's the beta, 1.5. So this one just change of subject. You are giving some of the items, so you just group items. That's all. That's all. So it's just like small mathematics. You don't have to do any difficult things there. You don't have to confuse yourself. So that is it. All right, let's go to the next one.
The B's, calculate the capital required return for each project.
Okay, the CAPM required. Okay. How do we do that?
So initial capital expected.
It's just the cost of equity that they're asking you for each of the projects.
Yes.
Okay. So how do you go about it? How do we go about it? So are we saying that if we should
We use the growth. I'm going to use the growth now.
grow for what? They're asking you
I'm
CAPM.
asking you.
They're asking you CAPM that you want to use growth.
CEO.
So since they have given each project the separate beta, so we just pick the company's market value, that's the 15%, and then risk-free, and then use the project beta.
So what happened? What happened that you are not able to do this thing for me? Senior, what happened? Or at that time, that this idea is not coming.
Yeah.
Okay.
How would it
Now
come?
they say you should calculate the what? The capital required return for each project. So since you are giving the beta for each of them, you just calculate the what? The cost of equity for each of them one by one, using using the risk-free and then the 15%. So you take the first one and calculate the return on it. So you just come to the project A, you have your 8% over there plus 0.3 multiplied by the 15% minus the 8%. So you'll be having KE 8% plus 0.3 multiplied by 7%. What will be the total? I'm having 10.1%. So you
Correct.
come to project B. So project B, the cost of equity will be 8%. What is the beta factor there?
0.5.
Okay. So you have 8% plus 3.5%. So let's come to
11.5.
the C. 8% plus, what is this? Is it 1?
1. Yes.
Okay. So we have 15% minus 8%. Okay. And that will give us 8% plus 7%. Then we have 15%. Okay. You can see that the instrument with the lowest what? Lowest beta is having a what? Lowest return, isn't it?
Mm.
Yeah, it's because of the risk level. It's because of the risk level. That explains the defensive and then the what? The aggressive. So you can see that the one that is 1. You see the 1. Okay.
Yes.
Because it's very risky, the return has to be higher than any of them. So this one, if they ask you that you should advise, don't go and say that it should be 15%. Maybe the 15%, what if something happened? It means the company is going to be losing all of its investments. Okay. So let's go to the last one. Then we know that we are done for.
The C is saying if the company decided to invest 40% in project 1, 30% in project 2, and 30% in project 3, what will be the weighted average beta for the new investment?
Okay. So how do you go about this one? How do we go about it?
Are we going to do 40 over 100 times the KE for the project A?
Is the question
That's
for
what
me
I'm
or you are saying it yourself?
I said that's what I'm thinking. So maybe 40 over 100 times the cost of it.
Hey,
See what? Average beta, sorry. Hey,
so
beta.
many. Hey.
Okay.
Wow.
Beta. So beta.
Now, what are we doing? How do we find that? I'm even looking at the question 5. You try it and send me the solution. It's not difficult. Okay. I'm looking at the question 5 and see whether I can be able to explain some technical issues there. But there's no technical issue there. So let's move on. What are we doing? Okay, they say that if the company decides to, so the WACC, the weighted, this one will be just the investment. So multiply this by 0.4, multiply this by 0.3, multiply this by 0.2. So just multiply their beta by their respective percentage, and the final answer, you put it together. That is the WACC. And then, are you okay?
Oh, okay, so you are not going to do any over 100 and multiply it by that one.
Or if you do over 100, so it's the same as 0.4.
Okay.
Okay. You just multiply them by their respective percentages and put it together. That is all. So I think that I still have some 10 minutes. Let me use the 10 minutes to explain this one. Okay. Okay. You can see that they have given you what? The capital structure is having equity shares, preference shares, bank term loan, and irredeemable what? Loan notes. Okay. And the ordinary shares have a current market price of 2 cedi. Dividend per share in pesos in the 5 preceding years were as follows. Okay. Okay. So they have given the dividend over here. The ordinary dividend for 2015 has just been paid. The bank is currently charging 10% on the loan. Okay. The preference shares are currently priced in the market at 0.7 per share, and the dividend is just about to be paid. The loan stock has an interest market price of 75 against a nominal value of 100 Ghana cedis. The company pays corporation tax at a rate of 30%. Okay, at a rate of 30%. Okay, calculate a suitable discount rate that MatchCo will use when appraising the new theme park project. So the cost that they are asking you is just calculate the weighted average cost of capital. How do we calculate that? That is the issue. You have to determine the cost of equity. So if you want to know your WACC now, your WACC will be like this. The capital structure is now 4. So your WACC will be the VE, which is the value of equity, divided by VE plus the preference share, VF, plus the bank loan, which will be maybe VB, plus the VD. So you put all of them together to calculate your WACC, because you are going to be using all of them, and all of them are carrying interest. The interest on the bank is 10%. So you have to come and calculate the cost of what? The preference shares. How do we do that? It is the preference dividends divided by their market value. So you look at the preference dividend. What will be the preference dividend? It will be 10% on 50 pesos. So we calculate it on their value per share, their nominal value per share, and that will be 5 pesos. That will be 5 pesos. Okay. Then you now come and see whether you are giving the
market price
of the shares. Okay. Let's say the preference shares are currently priced in the market at what?
70 pesos.
Okay. And dividend is just about to be paid. So whenever they are saying that dividend is just about to be paid, we assume that the dividend is part of this one. So this is assumed to be a cum div what? Price. But if they say the dividend has been paid, it means that dividend is not captured in the price. But if they say the dividend is about to be paid, it means that the dividend payment has been captured in the price. So the ex-div price should be 0.65. So we take the dividend out of it. Whenever the question says that the dividend is about to be paid, it means that they have taken the dividend into the valuation of the shares. So take the dividend, the share from it, and the remaining value will now be the actual value of the share, which we call the ex-div price. Okay. So you now do the 5 pesos divided by 0.65 multiplied by 100. Okay. So what we do is preference shares, preference shares are not, or dividends are not what? Tax deductible. So we don't calculate tax on the dividends. Okay. But if you come to the debt is an irredeemable debt. So it will be the interest into bracket 1 minus t divided by the price all multiplied by 100. So you can see that the percentage is 8%. So that will be 8% on the nominal value. That will be 8. So 8 into bracket 1 minus 0.3. Okay, all divided by 75, which is the current market price times 100. So that will give you the cost. Then you now find the market value for each of them. The cost of equity, you are going to be using dividend valuation model, which is growth, because they have given you dividends and they are growth one. So you calculate the growth. How do you calculate the growth? The G is calculated using the trend analysis because we are giving dividends. So you use the trend analysis. G is equal to the end fruit of the current dividends over the initial dividends, all minus 1. Then you multiply the answer by 100. Or someone can also see the dividend 1 over dividend 0, which is the first dividend and then the current dividend. And all exponents 1 over n minus 1 times 100. So anyhow you want to do it, just try it and you send me the solution. So the cost over there is the cost of the WACC. So you find your cost of equity. You have to know that whenever you are calculating WACC, you always have to use market values unless the question says you use book values. So you find the market value and you find the cost of capital for each of them. That is all. All right, so seniors, this is how far we have come. And at least we are done with the right issue, the theory issues, the cost of capital. Tomorrow we look at business valuation and the time value of money. Thursday, maybe financial risk management, portion of investment appraisal. Then Friday, we finish with working capital and some portion of the investment appraisal again. All right, please, do you have any question?
How soon can we have access to the working papers?
I don't know why you want to go if you are watching the video, unless you don't want to solve questions. If you're watching the video, you can pause the video and be solving the question yourself. What do you want the working this thing for? You want to mobilize the solution. The video will be there and I'll solve everything in the video. So just go back to watching the video. If you are watching, pause, solve the question yourself and continue and see whether the answer that you have gotten it. That is how we learn. But you just want to see how I've written on this particular working sheet. See, I'll write some things inside. I don't even label it with question numbers. And you are going to look at only this particular working sheet. You don't even know which question that we have solved first. I'm not even labeling it with question numbers. If it should be with
Hello,
question numbers,
sir.
then you can memorize it. Yes, please.
Please, where would the video be posted?
Okay, all things being equal, it can be this evening or maybe tomorrow in the morning. It depends.
Okay.
If I don't sleep early, then I will do it. So you can see that I'm not even labeling the this thing. So how do you follow it? Adam, how do you follow this thing? Because the question numbers are not there.
We'll follow.
So it will be the video. Me, I will send. I've saved it. It will be the video that will help you because the video we are mentioning the questions and we are solving. So just watch, pause, watch, pause, watch, pause. That's how we do it. You can't use magic. There is no magic anywhere. You can't just be using magic and say, no, God is not from Africa.
I know there.
No, God is not from
Hello,
Africa
sir.
that he will be doing favoritism. Like he will look at your face and say, "We pass." No. So you have to do more, and God will bless you. That is all. That is how it works. Okay.
Hello, sir.
Yes.
Please, the business valuation in FM,
Yes, please.
is it the same as the one in corporate report?
Yes, please. But the FM is more detailed than the corporate reporting.
Oh, okay. I see.
The FM is all the corporate reporting is just the valuation of the equity side. Okay. The FM we do the valuation of the debt and the equity.
Oh, okay.
All right.
But please, when are you treating the business valuation?
For which one?
Tomorrow.
For the
Tomorrow.
FM?
FM is tomorrow.
The revision?
Yes.
That will be tomorrow.
Yes, please.
Oh, okay, okay. Thank you very much.
All right, sir. Welcome.